So that, you know, that kind of agrees that the project the risk was that 10 million different projects for many bits. Okay. Good afternoon, everybody, and welcome to the next event in our Finance Day series. And in this event, focusing on the Climate Finance Accelerator, which is a project that the NBI are doing with Green Cape and supported by BEIS through the UK government. A project that I am personally particularly excited about because it originated out of a project that we did way back in 2013, looking at the barriers to low carbon investment. And one of those barriers was making the linkage between the project developers and the financiers. So there can be lots of finance available, but the project developers, don't know how to access it or aren't positioning projects in the right way. And so this project is specifically seeking to solve that particular problem, which is a significant problem across the world. And so, today we're going to be talking about people getting spoken to by people who are involved in the projects in various roles, but also in the broader financial services sector in South Africa, trying to make those kinds of linkages. So really excited about the discussion. And I'm going to ask Jenny McInnes, the Deputy Director for International Climate Finance at the UK Department for Business, Energy and Industrial Strategy, who kind of kicked this all off around the world, to give us a quick introduction. Thanks, Jenny.
Thank you very much, Stephen, and good afternoon, everyone. It's fantastic to be here. I hope you're all keeping well and healthy. We're on day 9. We're making really good progress. My name is Jenny McInnes. I'm the Deputy Director for International Climate Finance and the Programme Director for this programme, the Climate Finance Accelerator, and a number of other critical climate TA capacity building programmes from the UK government. And I'm really delighted to be here in person speaking at this event, having supported the launch of the Climate Finance Accelerator virtually only a few months ago. And just to actually be able to meet people and have this sort of celebratory event and explain what we've been doing is really fantastic to do that in person. So obviously this is a programme that the UK provides international climate finance towards, and that the National Business Initiative alongside Green Cape deliver in South Africa. So thank you for hosting the event and for inviting me. And I must just apologise in advance that I'm going to have to leave after I speak, but I wish you well for the rest of your event. So, we've heard a lot over the last week, the critical role that finance has to play in the climate discussions and in all of the implementation that needs to happen next after we've seen the ambition on the table from countries this week and last week. And, without the resources to pay for the projects, these commitments can feel very much like empty words. And we know that that money is available. We've heard really big numbers being thrown around, but we know that they're not getting to the right places. That money is not reaching the communities that need it the most, the communities that are having to make that transition. So if there's enough money in the global financial system, why is it not flowing at the pace that's required? What are the barriers to mobilizing this investment into real world projects and translating those commitments into action? In the UK, the government recognizes that solving these challenges is the key to accelerating the low carbon transition. And that's why we're working closely with partner countries to help unlock private capital for sustainable infrastructure. South Africa is an obvious partner for us on climate. It's one of the largest economies in Africa, the 14th largest emitter in the world, a major global coal producer and consumer, but it's also transitioning to a low carbon, inclusive and climate resilient economy and society. Earlier this year, the South African cabinet approved an updated, more ambitious NDC in line with the Presidential Climate Change Coordinating Commission's recommendations. And the UK government is working with countries like South Africa that are demonstrating ambition, that need support to move into accelerated implementation to really support the implementation of this commitment. So, for example, one of our bilateral technical assistance programs, UK Pact, and the Climate Finance Accelerator, they both support work in priority low carbon sectors, including energy, transport, and finance. And we're committed to working with South Africa to address wider issues, including unemployment and economic development, by investing in the sectors of the future. At last week's World Leaders Summit, we announced a Just and Energy Transition Partnership. You will be well aware of that, I'm sure. And what that's working with South Africa and other countries, the USA, Germany, France, the EU. And the partnership aims to really pull together and coordinate our efforts to accelerate the decarbonisation of South Africa's economy while ensuring the transition is fair and just. And that's a really, really important part of the way that we work through our programs. So before handing over to MBI, I just wanted to share a few quick remarks on the CFA. Just 2 weeks ago, MBI and Green Cape hosted a 4-day workshop in South Africa, which brought together 13 low carbon project developers with 15 financial institutions, allowing them to learn from one another and helping to establish relationships between them, to share knowledge, to build expertise, and to break down those barriers that exist. Projects were selected through a competitive process. That process attracted over 120 proposals. So it's a really, really compelling initiative, collectively worth more than $10 billion. So this overwhelming response demonstrates the need for this kind of program. Projects ranged from electric vehicles to residential energy efficiency, solar generation, and innovative methods to decarbonize agriculture. And all of the projects had a focus on creating the jobs that are needed as South Africa makes its transition away from coal and looks to support the communities that are most vulnerable to the impacts of climate change. And I've been so encouraged to hear the positive feedback from the project developers and the financial experts, hear about the relationships that are being built. We look forward to continuing to work with these projects and supporting wider CFA activities in 2022 and beyond. And we very much see this as a long-term initiative to really support that transition. NBI have a fantastic lineup of speakers joining, both here and in person and virtually. So without further ado, I will hand back to Rio Tumetse, who can tell you more about the CFA's work in South Africa. Thank you very much and good luck with the rest of your COPs.
So thank you very much to Jenny for those opening remarks and just giving us some context and insight into the Climate Finance Accelerator. I'm going to give you a presentation that just touches on some of the work that we've been doing in South Africa and gives you a sense of the projects that we are working with as part of this first cohort of projects. So in terms of an introduction to the CFA, so broadly speaking, the program is actually implemented over a period of 4 years. It's a technical assistance program that is funded by the UK government, and it is active in a number of advanced developing economies. So there are a few countries, both on the African continent and more broadly around in South America and Pacifica, that are also participating in the program. And in terms of the number of phases that the program is divided into, there's a component that's focusing very much on in-country activities, around scoping, around making engagement possible amongst the various stakeholders at a country level. But then there's also a second component that is about bringing to the attention of a broader financial community through some of the events that are hosted in London, the various projects that are being proposed or implemented in the participating countries. So just to give you a sense of who's actually active in the CFA in South Africa in particular, noting that it is implemented globally, the NBI and Green Cape are the local delivery partners, and we work closely with the core delivery team, as well as the UK government in order to implement the program in South Africa. So that just gives you a sense of the project partners and some of the specific activities that we focus on in the implementation of the program. I think what's really key to how we've implemented the program is obviously getting a really good sense of what projects are being implemented and being able to identify that cohort of projects that we work with specifically. And in terms of the areas that we focus on, so there are a number of areas, and we've just highlighted 4 there in the presentation. The one component that's linked to the call for proposals is obviously the project assessment. Jenny mentioned that we had quite a good response from the community in South Africa in terms of the projects that came through. And these are the projects that we then focus on over the first part of the CFA on capacity building. And then the third part, is this multi-day event. So once we've got projects that we've identified and the cohort of project proponents going through a series of capacity building initiatives and measures in different areas. And then the multi-day event where we bring together the community of climate financing in South Africa. And that involves your policymakers, financiers, as well as the project proponents themselves to really start to build the conversations and the relationships that are required. And then beyond that, the core team continues to work quite closely with the projects that have been selected as part of the first cohort to continue to assist them in various areas and build capacity. So in terms of what we highlight from the project development perspective, the value of the CFA is really about making sure that projects are stronger, more robust, more attractive coming out of the program than they were actually coming in. There's a component around very intensive coaching and technical assistance, and really about building the networks and the platforms that are required to link up both with policymakers, but also importantly with the financial sector. So we launched our call for proposals earlier on this year, a few months back, really to identify projects that we thought we could work with going forward. And we've identified 13 projects that I'll speak a little bit about later on in the presentation. In terms of what we were looking for, we were focusing on projects that are fairly mature, so at least at pre-feasibility level. In terms of the ask from a financing perspective, we were targeting projects of $10 million or more. And obviously, in order to make these projects more investable, they did need to have a basis already of being commercially viable and being able to demonstrate that there could be returns from those projects. And very importantly, in addition to the financial components and understanding the context within which we operate and some of the challenges that South Africa faces, we did have quite a strong focus as well on bringing out the broader gender and social inclusion aspects. And that was one of the key areas that we looked at in determining the first cohort of projects. So in terms of what we ultimately identified, and this is just a quick overview, so noting that, of course, we were focusing on mitigation projects, and you can see that even though that's the case, there's quite a spread in terms of the sectors that were covered by the projects that we've received. So you've got projects that are coming from the energy sector, looking at waste as well, transport, agriculture, and those that are focusing more on financial mechanisms, on how to more broadly increase access to climate finance as their core focus area. I have listed the final projects that we actually selected, and I would invite you also to consult the NBI website. We have a little bit more detail about that final cohort of projects that we're working with, but here you get a sense of who these different actors are. And on our website, you're able to just click on each one of these and be able to get a bit more information and also access the individual project websites to give you a really good understanding of the central focus of that project, the teams, as well as some of those financing needs that they have identified. So in the beginning, I mentioned that in addition to the project assessment component, which entailed the call for proposals and just working more closely with the different project proponents to understand the projects and to identify those areas where additional capacity would be required, but also to enhance, I think, the general value proposition of those projects. A key part of it was also then bringing together the community of implementers in South Africa, and that involves both the policy space as well as the broader kind of private sector space. So we included in our South Africa CFA conference, which we held literally, I think, a week ago, all of those different stakeholders and really focusing on how do we connect our project proponents with the financial actors that are necessary in making sure that their projects are implemented. We thought it was also a wonderful opportunity, understanding where our financial sector is, to start to actualize and have practical engagement with specific projects and contribute to that capacity building in the financial sector as well. And then thirdly, to also make sure that policymakers are starting to understand both sides, both from the supply of finance, but also the experiences of project proponents themselves and perhaps the areas that we need to focus on and build going forward. So in terms of how we had structured the session, noting that in the past, it's been an in-person event, so we had to switch noting the conditions into an in-country event and an online event, and that was a novel experience in of itself. But we did manage to host the event over 4 days. We had a combination of open sessions where we invited the different stakeholders to really participate, and combine that with very, very intensive capacity building as well. And those were sessions that were focusing on the project proponents, working very closely with some of the financiers that were mentioned. And then at the end of the session, we really focused again on making sure that those connections were made, and provided various opportunities to network, to link up, but also to give us just some indication of how some of those projects have grown over the duration of the conference itself, working very closely with a range of financial sector experts. As a capacity building initiative where the technical assistance focuses on this area, we just wanted to make sure that we highlight, those different aspects that we're working on. So we looked at the financial components of the projects and their financial rigor. We looked at the technical aspects, and also being able to understand very clearly what the climate benefit of those projects was. And then we also looked at components around gender equity and broader social inclusion. And that was the basis for us for a well-structured and a really good climate project. And the capacity building that's provided is really to make sure that projects are well-rounded and are able to address and speak to all of those different components. So I mentioned very briefly that we worked quite closely with a range of financial sector experts. So these were invited and had demonstrated some interest in working closely with a subgroup of that cohort. And I just thought I would put up on the screen the actors that were participating in the program. And we made sure to focus on bringing in a range of different financial sector experts in an area. So looking at commercial banks, looking at development institutions, looking at those that also provide debt, as well as private equity. And we really wanted to get that rounded perspective when looking at the individual projects, and to be able to provide that expertise as a basis for taking our projects forward. So reflecting on our initial objectives through this in-country event, really we had some fantastic sessions where the opportunity to connect, I think, both between the financial sector experts, but also between the project proponents themselves, starting to identify areas of broader collaboration, or being able to offer additional insights into how project values can be enhanced. There was the presentation of the landscape mapping report that we had undertaken. So I think just an opportunity to even deepen the understanding of what is happening in the South African climate finance landscape, and some of those areas where we need to focus. We looked at both the demand component as well as the supply. So what are the key drivers for climate finance, and some of the dynamics that were playing out between those two parts of the value chain. And as I mentioned previously, we have focused very strongly on making sure we're able to address some of the key issues that South Africa is grappling with, so inequality being a huge one, and made sure that the gender equity and social inclusion component of the project was also well highlighted, and had many discussions and webinars and really wonderful experts speaking to us on some of the initiatives that are taking place. And then finally, throughout the session, we had opportunities as we had engaged in various forms to really reflect back on some of the learnings and the key outcomes that had come from the different sessions. So both networking sessions, but also those where we had very in-depth discussions with the cohorts themselves, the cohort itself, as well as the financial expert facilitators, and the various panel discussions we had had. So in terms of where we will be going to from here, that was just the initial part of the program, and we look forward to embedding a CFA type process in how South Africa really operates going forward. And for us, that's a key part of being able to program and unpack South Africa's NDC, and actually be able to make sure that we've got concrete, well-defined projects that we can implement on an ongoing basis in order to reach that NDC goal. And I think that's it from me, just giving you a sense of the work that we've been doing. And I would invite you, I think, particularly to the NBR website, where we've got a few more details about the projects themselves, and you're able to access some of the resources that we've developed as part of implementing this project. So I'd like to hand over to Steve now. We've got a wonderful panel that's joined us today. So thank you very much for making time, those who are here in person as well as virtually. And Steve is going to be hosting the panel discussion and getting more insights. So thank you very much.
Thank you, Smithy, and a quick welcome to our panelists. So this project is really about getting money on the ground, getting stuff done, and that's one of the biggest challenges, connecting capital to projects. And we've got a really great panel from a range of financial service sector players to give us their insight today. We've got Olympus Mantata from the DBSA. The DBSA is one of South Africa's big development banks. Shamila Subramoni from the Johannesburg Stock Exchange, and then Nigel Beck from Rand Mission Bank, which is one of the big investment banks in the country. And then online, we've got Tumi Leai from Ushiri Capital. So a really good mix of players. And one of the key questions I'll be asking is how often do you actually talk to each other, which is a big part of the challenge. But initially, I'm going to ask each of the panelists to just reflect a little bit on the challenges that face getting capital and projects connected in South Africa, but then also just to reflect a little bit on the Climate Finance Accelerator and how that can play an effective role in South Africa. So Olympus, I'm going to ask you to kick off.
Thank you very much, Steve, and thanks again for inviting me to this panel discussion. We have had an opportunity on our side to engage with the CFA team, and we think it's a commendable initiative that is being undertaken, and very much willing to continue supporting the initiative. I think with regard to the question of, at least the challenges that we see and that I believe this initiative seeks to address is, first, just the limited support for early stage climate projects, but I don't think this is limited to climate project generally. You'll find this in most cases where early stage projects are concerned, and it could be because of various reasons. Sometimes, simply because the sector that you are looking at is less understood, and therefore affecting the ability of potential funders to appropriately appraise, and therefore a bit of hesitation, and that's sometimes leading to, a perception of risk, and therefore a way of just finding appropriate ways to, credit enhance interventions that would allow these projects to take off the ground becomes quite important. And of course, I think in this regard, the availability of appropriate funds or financial instruments, becomes key. But another point that I think is worth mentioning is that, typically you also face the question of high transaction costs, because, the size of the project doesn't necessarily always correspond to, the type of transactional cost you look at. Even when you look at smaller projects, the transaction cost would not necessarily come down as you'd expect. So sometimes that becomes a bit of a challenge. The other issue being, the requirements around, meeting compliance requirements for a small project can be quite, prohibitive, and therefore, creating the challenge. And we think, that's why a programmatic approach could be, quite useful, especially where you can start, finding ways of, sharing costs, but also a standardization of approach, contracting documents, requirements, that standardization can bring about a reduction in costs. But also, lastly, what I wanted to mention around these key challenges would be regulatory issues. You know, your financial structuring is done within the context of a policy or regulatory environment. So when that changes at will, it could have unintended consequences. And so is delays sometimes in certainty around policy, which could have significant costs that you know, your smaller projects might not be able to absorb. So I just wanted to mention those three in terms of challenges that you typically face. But the thing that I wanted to mention, especially from a, you know, a DBSA point of view, is that we find our intervention, especially around project preparation, being quite important, especially in helping transition projects to bankability. And I'm sure you'd accept that you don't find much of this type of project preparation interventions in the market. But having said that, you still find that the starting point or the entry point, even where project preparation interventions are concerned, could still be a concern. For example, on our side, typically we would look at projects that would at least be at feasibility stage to look at supporting them from a project preparation point of view. So if a project is earlier on, then you have that gap that can be a bit problematic to address. And that's why for us, you know, partnerships, especially with programs like, you know, the CFA becomes quite key to see how we bridge the gap, but in a way that makes sense, where one can fit a pipeline of project into the other so that you don't get stuck in terms of the development of projects. So in our engagement with the team, we found that that is a, you know, a potential a gap that we believe we can, you know, work together on. We have seen this recently with a facility that we put together, the DBSA, with support from the GCF on embedded generation projects, where we start talking to especially clients within your municipal space who would have projects that are a lot earlier than our project preparation facilities. And in one of the cases, we have worked with a UK Pact to help at least take the projects from concept towards feasibility, so that when they get to feasibility, at least they are at the entry point of our project preparation facility, and we can then transition them to bankability. And when they reach bankability, then they can benefit from, you know, our embedded generation facility. So that value chain, understanding that value chain and what needs to happen at each point becomes quite key. And the partnerships in this regard are quite important. So we're really looking forward to continue working with the team, you know, as I've explained, hopefully in a way that can unlock significant number of projects in the market. Thank you very much, Steve.
That's great. Thanks, Olympus. I'm going to jump straight along to Shamila from the JSE, who's going to give us some of your insights.
Thank you, Steve. And hi to everybody joining us today. It's great to be here. The atmosphere of a lot of excitement on the back of the announcement last week of the package, and I think this morning really exhilarating discussions on what we need to do and the challenge that lies ahead. The JSE, in terms of the climate finance landscape, obviously plays in a particular niche, and one needs to consider the broader chain, you know, of finance and investment. And where does early stage come from? You know, where does kind of this pre-feasibility sort of funding come from? And then where in that spectrum does the JSE fit in? So we don't traditionally play in that early stage, but we have recently started looking at the development of that. So we have had an accelerator program that is coming to a conclusion now, that has been developed specifically small businesses with very similar profiles to what has been supported by the CFA. So I'm very excited personally to see what the CFA program is doing, particularly in the climate finance landscape, because those potentially then become pipelines for the listed market at some point as you want to scale those businesses, of course, should they want to be in the public space, right? But that is where we see some of that happening and a lot of that development that's needed. So we ourselves have started looking at accelerators. There's huge opportunity for collaboration on that, with particularly using the lens of those kinds of companies that are more future fit. that are going to enable that green economy, that are going to enable the transition that we know that needs to happen. One of the areas we look at very closely is the aspect of risk in the market, and considering, as a context right now, if you had to look at a basket of stocks on the JSE, what are you exposed to? And the sectors you're predominantly going to be exposed to are going to be financial services, mining, those sorts of, and then of course FMCG a little bit, and telecoms predominantly. So not predominantly, but that would be the kind of makeup you're looking at. And then you look at that and you've got to understand what is the embedded risk, what is the risk of stranded assets, and the need to develop future fit companies that are going to have to be the companies of the future. So both those transitioning, like we heard from the Sasol and Exaro this morning, to those that are really going to be the next Sasol and the Exaro in the greener space going forward. And that's where we're trying to develop in that landscape. We've also recently started doing the development work on a private placements platform. So that is now outside of the listed space, to be able to say, well, that is another need that is there in the market. It was predominantly set up with the concern of infrastructure and infrastructure development, where a private placements platform could help with that. And of course, then, is this gone off? Green infrastructure would be a big part of that. So we know that South Africa has announced a green infrastructure plan, and there is a lot that needs to happen. But then again, even in that plan, one of the clear needs has been the need for bankable projects. And so a program like the CFA program really ticks that box. So if we look at that spectrum of financing, we have the very early stage, which is of course even pre the CFA type of cohort that you're looking at, to this cohort, to then the almost market ready with a small cap type of company, and then graduating into bigger caps. So JSE plays along that spectrum from a financing perspective. Then if we look at what else the JSE could do, and the role of markets really is ideally to create an enabling environment for better sustainability practices to grow and flourish. So clearly it's not just about the financing that you do, and there are instruments, of course, that already exist that can help to do that. We have an ESG index that has data that's carrying for the last 6 years on companies being assessed for ESG in our market. So you could look at that. You could, deep dive into a climate component if you want to look at companies that are doing really well on their climate scoring. We also have a segment for green bonds, social bonds, and sustainability bonds, which we went live with in 2017, and then included social and sustainability last year, which has shown great traction. And this year, I think we topped the $1 billion issuances, small in terms of the broader bond market, but nonetheless quite significant in the capital raising that's been done on that segment. And soon to come, by the end of this year, will be transition bonds and sustainability linked bonds. And we will be, I think, one of the first emerging markets in the world to actually look at transition bonds. So a bit of a bold move from us, because even the details around that haven't been worked out completely, but we understand fully that there's a massive need for that in a country like ours. We've had conversations this morning, I think, that underscore that greatly. So there's another role that the public markets can play. And of course, underpinning all of that is the notion of credibility. When you come to market as an investor, you want to buy a product that have some level of assurance that is doing what it says it's going to do. And so that's where the regulatory arm of the JSE comes in, and trying to make sure that the way the rules are written for those products make it easier for investors to have confidence in what they're buying, and hopefully not stifle the issuer from being able to issue on the market. So that is what we're constantly trying to do and achieve, and grow that space so you can have instruments already that you can go and access. Just like many of the other markets in the world, our instruments in the sustainability segment have been between 3 and 5 times oversubscribed, showing you that there's real appetite for that debt in the listed context already. And so hopefully then we'll open up the road for many others to access those instruments that are already active in our market if they have the right projects coming to market. And then on creating the enabling environment, the other area, of course, is what do we do with listed companies to enable better disclosure? Because when investors come to market, they want to know, they want to have some level of confidence. They're going to look at those disclosures. And so we have recently embarked on a project to issue climate change and a broader sustainability disclosure guidance into the market. It's a very interesting time in which to do that, given the convergence that's happening globally around the standard space in that area. But our pre-feasibility kind of study has suggested that there is a big need for that, and there's a lot of appetite for companies. the companies on the upper end of your market cap in South Africa probably already are quite advanced in their reporting, but there's quite a large tail that could really benefit from guidance in that space. And in so doing, we take an entire market along a journey to be able to ultimately make that market better in terms of the disclosures that are presented. So it would be guidance at this stage. We hope to go live with the first public draft of that by the end of November, and that would be something that we want to shape up. We have a key component in there that's on the just transition element of disclosures to make it a lot more relevant to South African context for companies operating on our borders, and what does that mean, and what does just transition mean, and how does that translate into disclosures that are meaningful, that are useful to investors, that are useful to other stakeholders as well. And so those are the things we're doing. And then finally, of course, using our ability on engagement and advocacy, and saying what can we do to bring together the different aspects of the market. So another piece of work that we do is we're chairing the Sustainable Finance Working Group under the Financial Sector Climate Risk Forum, which has recently produced a handbook as the first piece of our output of work, which is really trying to understand, and it's taken a climate instrument first approach about capturing for anybody who needs to use this. So it's really capacity building. What instruments are out there? What could be most relevant for the South African context? How do you use them? And is aimed at saying, and to the point earlier on that was made in some of the panels this morning about the need to upskill, we need skills in sustainable finance. We need people to understand this. It mustn't be something mythical that, is just the sort of remit of a few people. And so the work that we did in the handbook is intended to be able to help with that education, whereas people probably would take months to go down many different wormholes trying to find information. This tries to collate it for them. If you're an investor, if you're an issuer, if you're somebody who is a company that's just looking to understand this, what are the frameworks, what's happening, what's relevant for the country? So Steve, those are a few of the areas that we're involved in that will support the market as a whole, that will help, the SA Inc. kind of a picture, but that are also very specific in making sure that our markets are globally relevant and that are a place that investors globally can come and invest in with confidence and with, a huge level of transparency. And just in terms of, I know ESG ratings have their own question marks, but we partner with FTSE Russell as the JSE to do some ESG ratings, and there are a number of others active in our market. FTSE has rated the South African market number 5 in the world globally on average ESG disclosure score. Now that's quite an achievement, and it's an emerging market, and there isn't mandatory disclosure in the market as yet. We have the King codes, and we have the consideration of integrated reporting, yes, but I think that's quite an achievement, and I think a testament to the companies who've made a lot of effort over a number of years to gradually do that, and for the JSE trying to really try and encourage that transparency where we can, and looking at just only publicly available information for those assessments. Thank you.
Yeah, very interesting. Thanks. And I think this idea, right, it's new to me, but it shouldn't be, right? Is this parallel raising of finance for projects, but also raising finance for enterprises and the relationship between those two. And so that successful project developers graduate their businesses into something that they list and attract capital on formal capital markets. That sort of value chain is interesting. I think something we can explore more. And I'll ask Nigel to give us some remarks.
Yeah, thanks, Steve. So I think, my comments are probably very similar to Olympus's, with regards to the barriers. The barriers I see, specifically traditionally has always been green technology, always been seen as pioneering, therefore as a commercial financial institution, quite often you did not give it due consideration. So in other words, it seemed to be too complicated and not worth your while. People didn't really look at it. Quite often those type of companies or small, medium enterprises, whatever you want to call them, would come with no feasibility studies. It was quite difficult to make them bankable. It was also difficult to actually understand exactly what they wanted from a financial perspective, whether they wanted debt, whether they wanted equity, what type of debt, et cetera, et cetera. Quite often when they wanted debt, they had no equity. There was often long-term debt as well. So, 15-year and above, which is often quite complicated for commercial banks to place that type of long-term debt. And often they're not scalable and replicable, which is kind of what you mentioned earlier, and those are the key things that I guess financial institutions, especially commercial financial institutions, would look at. I think with the CFA, and obviously where the opportunities are in the sector is it's significantly growing, and therefore financial institutions are looking at it slightly differently. They're looking at it more strategically. more likely to look at these opportunities and not shut the door where they previously would have. I guess what you would probably see, and it's kind of what you were saying, project preparation. It's kind of how do you work with the client to make sure that, now you can make it bankable? How can you structure the debt, or do they need equity? Do they need mezz? And then trying to overlay the opportunities. So trying to look at the various opportunities, whether it's renewable energy, energy efficiency, green buildings, whatever it might be, green hydrogen, specific products, and then the specific risk mitigants from the DFIs and multilaterals, which I think are part of the CFA, and essentially collaborating to try and make them bankable and financeable. That's long term. Yeah.
Thank you. Yeah, thank you. I think that a big thing that comes out of that, and maybe a couple of other talks, is the language that we use and what that comes with. So when you say things, you said a sentence there around often they want long-term debt. There's so much implication in that sentence that 90% of the market just doesn't understand, right? Like they don't. And I think that's a big part of the challenge. And one of the things that we're trying to address with the CFA program is to address the capacity of the project developer to talk the language they need to in order to attract finance. So our last panelist is online and has been nodding along vigorously to the discussion. So I'm going to assume that you have some really interesting views for us, Tumi, and look forward to your input. Please go ahead.
Yeah, it's can you guys hear me? Yeah, thank you so much for the opportunity again to kind of put our insights, however young we might be, into these sort of conversations. We're very fortunate that even at this age, we've had multiple conversations with the JSE, RMB, and the DVSA from exactly what Olympus has identified. Like Oshiri Capital exists for the early stage developer or entrepreneur. We took a view while we were still in the more corporate spaces, that a company that can assist a PhD student from a concept to commercialization was the pathway that we wanted to enable its success. And a large part of that sits with education around exactly that. Like, what's the difference between getting access to funding from tax revenue versus from a commercial bank like RMB with their Basel requirements, to insurance companies like Mutual, Sanlam, and their own statutory requirements, and also obviously pension funds and asset managers. And then if you have a view for a listing, then you plot out a path upon which a collection of those assets could be listed so that you can have a conversation with Shambila then. So in our practical experience, we've been, again, as I said, fortunate enough that we listed South Africa's first commercial SPAC. We've innovated quite a lot with RMB around some prefs in the BEE space. We've done a lot of work in accessing the DVSA's expertise and portfolio of assets around early stage project development. So it's within that kind of spectrum of project life cycles and development that we operate quite comfortably. We've been fortunate enough also because we do take an entrepreneurial view around innovation around financial instruments. So when we look at private credit facilities, for instance, we do take a much more leaner and a more entrepreneurial friendly outlook than the commercial guys or even the DFIs would look at, and also then walk the journey of development with the entrepreneurs. We obviously quite lucky that in terms of things like BEE, we're working quite closely with some of the first generation BEE trusts that have paid off their debts. They've gone through the consumption cycle, and now everybody wants to invest. The green economy and renewable energy is the buzzword, and climate mitigation, and they're looking to find ways upon which they could be also slowly moved into that investment landscape. And we've had the time and the energy and the resources for us to do so. So essentially, again, as I said, early stage, we reduce those high transaction costs that Olympus was talking about in terms of that UK packed role that sits with a South African entity that kind of understands the language on the ground and is able to kind of move the conversation forward from conceptualization, development, and right through to commercial operation. And that's the space that we've created for ourselves. And also I think it's very interesting to kind of put it out there. We operate from Cape Town, so it's a funny thing that like everybody's in Johannesburg, where geographically the green economy conversation in Cape Town is a very different one to the Johannesburg one in my experience, you know. So that gives us quite different insights, and also one of the key questions you asked me in the brief was what can you do? We've seen quite a lot of love coming out of partnerships with educational institutions, because firstly they play quite a meaningful role in creating pipeline, intellectually stimulating pipeline, but also so like it's almost like your government funding platform, because like the taxpayer pays for that initial research, and then by the time we can escalate it to like the more commercial and private sphere, then it's already kind of de-risked from like that perspective. So we've partnered up significantly with some of the educational institutions of the Western Cape that kind of feed us workforce ideas, and I think that's something that like even within the CFA program we would have to kind of going forward look into strengthening quite a bit. So yeah, so that's my reflections, and I welcome. Yeah.
I mean, maybe just a quick question for you, Tumi, before I move back to the panel here in the UK.
Sure.
What are you're talking a little bit more about early stage finance compared to the other panelists, but give me a sense of deal size here. Like when you're looking at a new deal and trying to push a new project through, are you talking 100 million rand, 10 million rand? What are you thinking?
It's typically we advised for a phased approach, just simply because that's the easiest way in which you can bite that cake or that apple or like whatever, you know. So deal and this is a very South African concept. If I have friends from Spain who, you know, in climate mitigation conversations, their government subsidizes that initial knock, you know, and it's very normal that in a South African context we just don't have those kind of facilities, or if you're going to access them, your enemy is time. So what we typically tell them is it's actually quite crazy that like once you are in the market and you're operating within the market, you find capital bases or sources that are quite non-traditional. A very good example of what we did, like when I was in my previous employment, but like we carried it across, was to do the work, the legwork to be issued with South Africa's first fatwa, which is the constitutional declaration that the REAP assets, if reconfigured in a certain way, are Sharia compliant, you know? And in that way, we were able to kind of go and access a completely different capital source and market that would, like a normal project developer wouldn't necessarily be like in tune with if they were looking for commercial sources. So that's what I'm saying. Like, and we've done a deal through, actually multiple deals through Section 42 asset for swap conversions, where old school kind of like white companies in a South African context that want to do good, they want to do asset transfers for equity into new BE companies to enable kind of like people like you who don't have balance sheets to get on with being able to have a conversation on R&D. Those have also found a lot of love and success. And then obviously the more obvious ones like your SED and CSI programs within the corporates, you know, like go to the guys that already have the cash that are mandated by the government to put it out there, and you'll get way more love out of a BEESD program and a CSI program that waited for the government to give you that money. So the turnaround for that kind of innovation around ways upon which you have to think out of the box in order to access that capital, and that capital is there. It's just like it's educating the developers and saying, look, okay, for your particular problem, why would you want to reinvent the wheel and go to a bank when there's a corporate that's looking for somebody like you that can partner up with you and you can work out some sort of equity transaction with it?
Yep.
You know?
Yeah, that's interesting. I mean, I guess the challenge I'm trying to get at here, and maybe we've only got like 7 minutes left, so I'm going to ask for some really rapid fire answers. I mean, my sense is that because you're being innovative, because you're getting money from here, because you're getting money from there for those early stage projects, they're not 100 million rand projects, right? And then if I look over at Nigel, I imagine you're not interested in a project that's less than 500 million, right? So maybe Nigel, you can kind of comment on that. Like that link between how do you get these relatively small scale enterprises. Shamina's talking about these relatively small scale projects. How do we create that environment that's going to be attractive to an investment bank?
Sorry, what about the microphone? So, I mean, first of all, you're right. I mean, generally as an investment bank, you're going to look for larger ticket transactions. But I think you must not forget, and people sometimes do forget, is that we're more than just investment. I mean, I guess First Rand also has commercial banking and other parts of the bank that you can actually get that type of financing. And I think what we are starting to do, and especially my business unit, is we're starting to work much more closely with what's happening in an F&B environment. So where we might have actually the skill set and the technical ability to structure some of these deals, and traditionally as a large investment bank, you might not be able to execute on them. We're actually providing those skills to our commercial banking colleagues, and we're essentially working with them quite closely to do that. So you are seeing a lot more collaboration in that space that you're talking about. So that's one thing. The other thing is what we do see is in certain instances where there's a transaction that might be substandard of some size, you will look at whether you can scale it. So in other words, can you replicate it and can you scale it? And that's another opportunity to look at as well. So I think, it probably goes back to my comments earlier. There is, I think the whole financial sector is changing the way it looks at these type of things. It kind of wants to try and make it work and will, where possible, try and work with you to make it successful.
Yeah, interesting. And Olympus, maybe to kind of follow on this theme, whenever I talk to financiers, there's this debate about who provides the risk tolerance capital, who takes first loss, who takes mezzanine, and that's meant to be the DFIs, right? But often I hear that the commercial banks are more competitive than the DFIs, predominantly because they're drawing retail money. But you're kind of, what's your reaction to that? What's the role of the DFI in this sort of value chain?
Yeah, that's an interesting one, Steve. I think we get it a lot from our end because the normal assumption is that you are a development bank, you are government owned, you're probably being capitalized through the sovereign, which is not always the case. Therefore, your ability to offer what people would typically expect might be constrained. But I just wanted to steal the opportunity and talk about something that I think is quite important in terms of connecting the various financing sources. What I've found becomes quite key, as Steve, is that the understanding of the mandate of the next source of funding is quite key for the initial one to be able to connect to the next. And sometimes we don't do that well enough. Therefore, we have got this project that have a lot of stop starts, because by the time they believe they are done, they are not ready for the next funder. And I think it's something quite important to address. I'm sorry I addressed what I wanted to talk to.
No,
more than
that's
your question. Thank you.
But I mean, what I think what's come across from a couple of the panelists is there's a temporal value chain here. That early risk finance has to be thinking about who's coming next, what their mandate is, how to prepare for it. And then there's this challenge of kind of scaling up relatively small starting projects or enterprises. I'm still fascinated by this idea of enterprise. That's scaling into a sort of an investment bank context where you've got either a project investment lens, or in the commercial banking scenario, you've got an enterprise investment lens, but you're still kind of linked to that underlying activity. Yeah, so that's kind of interesting. I don't know, Shamila, if you can talk a little bit more about if you've got something that's new and interesting that isn't a traditional business, like what are the listing options? I mean, are there listing options to list things that are new, that are trying to attract venture capital through a listed market? Like how does that work? Or is there a particular point at which you can access sort of JC funding? Obviously, the bond market is important in the project context.
Steve, in the equities context, you can definitely do that at the moment. I mean, the JSE, you immediately think blue chips, right, in your top 40s. But there is a market there that is the AltX, which is the exchange for smaller companies, and those rules are actually quite flexible, or should I say, less intense than those for the blue chips and the bigger market, the bigger cap market. So even in there, I mean, there would be things like, you would think you might need to have 10 years history in financials And you don't need to have those there.
Mhm.
You can come to those. You can actually access AltX there over time. So that's something we shouldn't forget. But yes, there would still be a size constraint. And I actually can't remember right now what the market cap requirement is for AltX. But there's often a perception barrier about what you need to be in terms of size, market cap, in liquidity, in free float in order to qualify to be listed on the exchange. And you immediately think the biggest companies, and that's not true. In fact, there's been a lot of value that's been had in the smaller stocks and a lot of effort by the exchange to start promoting the smaller listed stocks. But typically, the mandates of investors would chase the larger stocks because of liquidity, the market cap, the free floats, and the things like that, that their money is actually dictated to on.
Yeah.
And so that's what you need to look at. So there is definitely a space to look at that. The debt market, yes, traditionally is larger size issuances for capital raising.
So maybe just to follow up quickly on that, do you see larger asset managers and pension funds and the sort of asset owners engaging in the AltX market, or are they traditionally playing in the standard JSE top 40s?
Traditionally in the larger ones.
Yeah.
There's no doubt about that, but there is still a lot of value to be had in the smaller ones, as we're starting to see a lot recently. We've been trying to promote that as the JSE recently run a couple of these stock pick sessions as well that are trying to actually highlight those. Unfortunately, the bias ends up with analysts covering the bigger companies. So coverage of those companies is another issue. So once they're not covered, it's harder for investors to look at those. And so there is an opportunity for that partnership. Again, look across the scale and say, how can we do that? So there's a lot to be done in terms of making sure that that market already can be marketed and understood better. And then, of course, get people to start joining that possibly as an option, should that listed context be of value to them.
Yeah. Really great, and I wish we had 2 hours to continue this panel discussion, but unfortunately we've run out of time. I want to thank the panelists for their input, and I think we reached a point really where we're kind of exploring the complexity and how challenging it is, and hopefully the CFA, amongst other programs that were mentioned by the panelists, will help start to transition this conversation in South Africa. But there's clearly a need for us to be thinking about the journey from something small and experimental and entrepreneurial into something that's big and funded. And so, partly that's what the CFA is trying to address, but certainly something we need to continue this conversation in South Africa and in other countries, also drawing on work that the Treasury is doing on investment taxonomies and frameworks. So I want to thank you again, and we'll call this session a close. But those two in the audience here in South Africa and online, we are going to roll directly into another session looking at the investment environments in South Africa, in particular the role of DFIs, and thinking through how we translate transition risk into allocating capital into the right places. And so we invite you to stay for that session, and we'll take a very short 2-minute break while we set that up. Thank you, panelists. Have a wonderful day, and thank you to me in South Africa. I appreciate your input. And thank you to everyone online.
Thank you so much.
Bye, everyone.
All right, cheers. Bye.
Okay, what do you need to be clear? That's your way. Cheers, travel safe. Thank you, appreciate it. Welcome to the speakers online. We're just setting up on this side. If you give us another minute, and we'll kick off. And to those in the audience, also give us a couple of minutes to set up on the physical side, and we'll get going soon. Thank you. Catherine, can I quickly check that you're online? No. Okay, I'll be back in a second.
Hi, Matt. Hi, Anna.
Hello everyone.
I'm assuming there are some people in the room in this event.
Okay, welcome everybody, and thank you for your patience, those of you who've been online. And we're going to kickstart on this end. And really, the idea behind this session is as part of the Finance Day, mini Finance Day we've been hosting here at the South Africa Pavilion, is to get into the role of development finance institutions, and particularly thinking about how we take transition risk and use that transition risk understanding to identify areas of investment and actually get capital connected to those areas of investment. And so we've got a really great sort of session ahead of us with some speakers from some really important institutions. We're going to have Olympus share with us a little bit about the role of the DBSA and the journey of the DBSA in South Africa. Olympus was on our previous panel, so he's got a double session today. We've got Audrey from the AFD online. We've got Anna from the European Bank for Reconstruction and Development also online. And we've got Matthew Huxham from Climate Transition Analytics at Willis Towers Watson online. And interesting that you're here, Matt, because actually a conversation that you and I had probably 4 years ago now actually kicked off the work that NBI has done on transition risk and has actually made a really big impact in how South Africa thinks about transition risk and investment. So really great to be closing the loop with you here several years later when deals are being struck and activity is happening. So I'm looking forward to this session. I'm going to ask Olympus to kick off and just talk us through a little bit about the DBSA and the role of the DBSA and thinking through transition risk and investment in South Africa. And then I will come to everybody else online. Thank you.
Thank you very much, Steve. I think the first point that I really wanted to talk about is really what I believe is an important role that national development banks play in the space, especially, with regard to the ability of crowding in, especially private investment into supporting mitigation and adaptation initiatives. I think what is important about the role of development banks first has to do with the relationships that exist between development banks with first your commercial or private space, because of the history that exists in co-investment in various projects. There is that understanding in terms of what needs to be done and existing relationships. And I think that is quite key. But on the other hand, you find with your, development banks, which in most cases would be owned by governments, there's also that relationship with government on the one hand, which hopefully provides a possibility to influence a policy that's hopefully enhancing the enabling environment. So that puts your national development banks in a, if you like, sweet spot where you're able to pull the, the two together. But I see very much in our case also where through, for example, our accreditation to your GCFs and the GEF, you are then also able to tap into climate financing mechanisms where you can mobilize resources which you then blend with own resources to support projects that where additionality is concerned. So I really think there is that important role that we play. Talking specifically to the DBSA experience, I've found that we have really experienced that a cycle throughout the journey that we have had. And some of the key things that I thought were quite key in our journey was really the starting point in terms of developing and enabling a policy framework that allows us to do the things that we need to do. Starting from developing a climate change policy framework within the bank that defines, targets with regard to financial flows, into both mitigation and adaptation, and sort of starting the initial stages of trying to measure that and seeing how we are performing against that. And going on to looking at purely because of exposure, the energy sector in terms of where our portfolio sits. And the key thing being to understand what is our transition risk if we are to continue with business as usual, and trying to see what is the best way to respond to that in terms of what we need to do going forward. And that being followed by, a just transition a framework that tries to take, all these various components to say, how does it inform how the bank does its business? And, recently what we have looked at was to say, we've got these various policy frameworks that we've put in place. Now we would like to look at consolidating them into, an integrated sustainability framework that really start to inculcate our pathways towards net zero, and defining what that exactly means, and going into a deep dive in terms of understanding our portfolio and understanding what we need to do in that regard. So that is some of the things that we are looking at. But it's very easy to jump into a public pronouncement about where you seek to go without thinking about the capacity internally that would enable that. So we have really started in earnest to say we need to look at internal capacity to look at what needs to be in place, starting from our environmental and social safeguards and ensuring that we enhance that to respond to the work that we need to do. And also talking to the tools that we need to have in place, looking at reporting frameworks, your development results framework, and making sure that they are fit for purpose to do the work that we need to do. Starting to really put in place our response to, how we respond to, for example, your TCFD reporting, and we started a lot of work around that. And also, we benefit quite a lot from our membership of the IDFC, the type of development finance institutions, our common reporting, lessons sharing, and how we start to really, start, learning from each other. And we really believe that, lays a foundation that allows you to do what you need to do in this area. But the other thing that I wanted to talk to quickly is the importance of, partnerships. In partnerships here, I talk about, starting from the accreditations that I talked to your GEF, GCFs, but also the relationships with, MDBs, the green credit lines that we are able to access that are quite helpful, especially in assisting us with issues around cost of funding where we are concerned. And we think, that is quite important. And we use that as a base really to start developing, innovative financial instrument, financial solutions that responds to the need in the market. And, for us, that is quite important. I'm sure some of you would be aware of facilities that we have recently put in place in partnership with the GCF. For example, your climate financing facility that is active in, South Africa, Eswatini, Lesotho, and Namibia, and the important work that does in helping countries in our region to, especially in the implementation of NDCs, and recently also locally in South Africa, putting in place an embedded generation investment program to respond to the allocation within the IRP around embedded generation. So very important components, but these partnerships and these capacities that I've talked about and the policy frameworks really create that environment that allow us to do this. And we are also using these partnerships to create new platforms that we believe are quite key, especially on the adaptation side. We are looking quite a lot on the water side and starting to design what we believe would be national programs that would help us to significantly start responding to this significant need that I'm sure everybody is aware of. So, you put all this together, the, electric mobility that we are working on with the JEF, it really allows us to really start, putting in place a response to the need that is out there in the market. I'll stop there for now. Thank you very much.
Great, thanks, Nicholas. I think maybe what I'm going to do is mess with the order a little bit of the plan and ask Matt to come in and just talk about the assessment of transition risk and the role of transition risk in this kind of process of allocating capital, and then ask Audrey and Anna if they can talk about how they've experienced that within their institutions and maybe cite some examples of places where you've used this understanding of risk in an economy and in a sector to allocate capital. So Matt, can I ask you to jump in? I hope that's okay with the speakers.
Thanks, Steve. Can you hear me okay on that
Perfectly,
side?
thanks. Yeah,
okay, great. So yeah, and thanks for the opportunity to join this, even though I'm not physically in the room. Just a little bit of context. So I work for Willis Towers Watson, which is a large international risk measurement and management company across a whole load of different types of capital. But my experience in South Africa, really focused on analyzing and understanding the transition risks in the country came when I was a couple of years ago when I was at a think tank called Climate Policy Initiative, and we published a report, as you mentioned, Steve, in March 2019, which was really a first attempt to try to set out an understanding economy-wide, system-wide, to understand the sorts of vulnerabilities that South Africa potentially was exposed to, and then we tried to give some ideas about what potential solutions might be. And in that we had to consider the role of the different parts of the South African public sector in particular, including DBSA and the IDC, and which sit kind of on the side a little bit, as well as different parts of government and the SARB. And so what I'm going to do very briefly is just to explain a little bit about what we found and why we thought it was important, then to draw out some implications for what we think in terms of the role of development banks, and maybe something briefly about the positioning of the DBSA that we thought was quite distinctive at the time. So the first point, I suppose, is that we realized pretty early on that there wasn't that much of a good correlation between greenhouse gas emissions and transition risk. So South Africa, as we know, has a number of very emissions intensive sectors, including power and industry and steel, for example. But the sectors that were most at risk that we identified, the ones where cash flows would decline if the world shifted towards well below 2 degrees or 1.5 degrees, were not necessarily the ones producing the domestic emissions, but the ones exposed to the external markets, and and which were were facing the impact of a global transition that might actually happen faster than South Africa's transition. Now, a lot has changed since, but I think the kind of the crux of those findings remain the same effectively, and the purpose of what we were doing by trying to identify those risk concentrations was to help guide financial institutions, I would say particularly development financial institutions, to understand, which investments were likely to be adding risk to the system, and which ones could potentially reduce risk to the system, and therefore where development finance could be most impactful. And so, a lot of the very good work that the DBSA was doing at the time, particularly around in the early days of the South African renewable energy industry, was really catalyzing a market. But we've kind of gone further than that. So just a couple of thoughts about what we found for those on the call. So we found very significant downside risk in the South African economy. Bearing in mind this is a couple of years ago, South Africa still had its investment grade rating, but risk of over $100 billion in net present value terms between 2018 and 2035. And we focused a lot on the implications for export coal. There are other more positive stories, I think, around some of the other metals, around the fact that South Africa, remains a net importer of oil. But we felt that you really needed to dig into the sectoral details and the sectoral specific scenarios to understand where the risks lay. Then probably the most important part was not necessarily the size of the risk, but the analysis of who bears the risk. So we did a lot of work trying to understand the transmission channels throughout the economy and the financial system, right? And we found out that there was a lot of financial risk sitting on large corporates, including some of the ones who are going to be presenting at this event today. But the large corporates were really the ones who were probably better able to deal with those risks. They had more options in terms of access to capital, greater starting resilience. But we also found, we found significant risk sitting on a whole load of parties that were not really well able to deal with it. So particularly some of the smaller mining companies, a lot of the, the Black Empowerment Enterprise, independent miners, and also the municipalities, where of course DBSA is an absolutely key funder. So, what we found was a number of areas where we thought, if this risk were to crystallize, it could create, serious problems for certain of these entities. And that maybe, in the areas where, DBSA and partner institution, the IDC, had a particular role to play in that context. What's also changed since we did that report, and I'd actually be very interested to hear the opinions of the DBSA colleagues if we have time, is what's changed is a bit of a paradigm shift in financial markets. So we've started to see the growth of the ESG theme, the growth of climate-related financial risk disclosure, and a trend in some cases, for international investors to divest from South Africa. Some of the big mining companies who've sold their coal mines to local players, for example. I've even heard that, anecdotally at least, of the challenges that certain emissions-intensive companies may face in getting hold of insurance, in terms of getting access to capital at reasonable rates. And so we have two different types of transitions going on potentially in South Africa. One is driven by the global trends and how they affect on South Africa's industries and municipalities and the sovereign credit rating, of course. And then a kind of trend that's endogenous to the financial sector. And that, in the context of those two things, I thought, well, what's the distinctive role of a development bank here as opposed to just another financial institution? Well, the first one really obvious though it probably seems, is to support investments that are at least positive in terms of transition risk, not to make major infrastructure investments that are actually making the picture worse. Second one is to, and I think this then really relates to the theme of the just transition, is to particularly target those areas that need the most support. They have least risk-bearing capacity. And here I think, the work that's happening in Mpumalanga around some of the areas where mines and Eskom power plants are closed is a particular area of value and innovation, I think, because, and Olympus was talking about the need for development banks to help leverage in private capital. Well, here is an area probably where the investment case is less clear in some cases, and particularly where a development bank can play a significant role. The final point that I just wanted to make, we're asking questions generally speaking about development banks, but I think the role probably is very different depending on the particular context. So the role of a development bank in South Africa might be different than the role of a development bank in another part of the world, because of the way in which it interacts with the National Treasury, the SARB, the central bank, and the rest of the other development banks, as well as the interaction with international players like AFD. And so it seems clear to me that DBSA, at least as far as I knew it previously, has particular areas of expertise, including in the state-owned enterprise and public-private partnerships and the municipalities that I mentioned. But there might be the opportunity to do more than just the lending and also the project preparation work, which has been so valuable over the years, but to help help broaden the awareness of transition risk scenarios amongst the South African financial sector and those parties who you're trying to bring in through the partnerships that you mentioned. And one final thing is, I know that this isn't an event within the South African Pavilion, but I understand that DBSA has a mandate beyond South Africa within the SADC region, and I'd be interested to see if you'd feel any different about your mandate in relation to the just transition outside of South Africa as you do inside.
Great, thanks, Matt. Yeah, some really interesting points there, and I also pick up on this idea of a just transition, and so far we've spoken very much about sort of trade risk and exposure and solutions that are kind of technology oriented. I would be interested in, as Audrey and Anna, as you give your feedback, to sort of comment on the social aspects of a just transition and how we build those into transactions, and we'll also be very curious about examples you might have of that. So Audrey, I'll ask you to go first.
Yeah, thank you very much. I hope you hear me well. I would like to thank you very much for having organized this important event, and good afternoon to all the panelists. I speak from Johannesburg. You might see it where I am based, and where I am responsible for AFD's operation in South Africa. I would like to start by saying that DBSA is actually a key strategic partner for us, for AFD. We have worked on many occasions supporting South African municipalities, some national and regional infrastructures, and on the first DBSA green bond issuance. And I congratulate the DBSA team led by Olympus for the second green bonds issuance. With the DBSA, actually, we are not only financing together, we are also thinking together. And we supported the CPI study on low carbon transition risk for the South African economy. And we support together a greater role and a greater collaboration among public development banks, either, as mentioned by Olympus, in the framework of the International Development Finance Club, or within the Financing Common Initiative, where we are both active members. If I go back on the role of public development banks, as discussed with my colleagues, and I support what has already been said, I would add that whether they are national, regional, international, or multilateral, public development banks are expected to be present when our partners most need our support, meaning when they need to engage in a transition, not when they have already fully transitioned. And South Africa needs support now. And be present means not only provide financing, but provide aligned financing. And you all know that last week, the governments of South Africa, France, Germany, the United Kingdom, the United States, along with the European Union, have issued a political declaration that forms a new partnership to support South Africa's just energy transition. And we hope this first commitment to cooperate will open the doors for more partners. And we also hope that it will inspire other global commitments in other countries, especially in emerging economies. So for now, this partnership will seek to mobilize an initial commitment of 8.5 billion US dollar to contribute to close the financing gap. Out of this amount, France, through AFD, has proposed the South African partners to make 1 billion euros available to support the transition. Now, and in line with what has already been said, the definition of closing the financing gap needs careful reflection. South Africa faces multiple challenges, and we need to look beyond emissions reduction and consider all the implications of the energy transition. When discussing the financing of the low carbon transition, we need to have a holistic and integrated approach and be aware that it is not only the technological transition that needs to be funded, but also the social aspects, the just part of this transition, as you mentioned. We have to pay attention to how the financial system is adapted to support long-term sustainable trajectories and how the financial system is designed to provide the finance we need for the future we want, as we say. So yes, we have to not only support the CO2 emissions reduction, but also to look at how to support the affected communities, how to foster job creation, how to promote the economic diversification, the territories reconversion, the pollution management, and the local public policy making, among others. And this support can be deployed through various actors. We have the government, the state-owned enterprises like ESCOM, the municipalities, as you said, Matt, the private sector, the civil society, and the academics. Together with all these actors, we can define what we call the aligned finance to close the alignment gap. This is precisely the objective of the Finance in Common initiative that gathers the more than 500 public development banks in the world. In their joint declaration signed on the occasion of the first summit back in 2020, they have jointly committed to align their strategies and their operations with sustainable finance principles. And actually, we say finance in common because we need to all go in the same direction, the one defined by the Paris Agreement and the UN Sustainable Development Goals. And we need to join forces, as you said, Olympus, first among public development banks to make sure we have a coherent approach in our operations, and second, to collaborate closely with governments, central banks, private sector, civil society, and even researchers. Public development banks like DBSA, EBRD, and AFD here today, we have a unique role to play in the financial system, and it has just been recognized by the G20 ministers of finance in their last communique. It was in Rome in October. Because yes, actually, with our public mandate, you specified, Olympus, that we are owned by the state. And with these public mandates, we build bridges between governments and the private sector, between domestic and international agendas, and between short-term and long-term priorities, and we can therefore significantly contribute to reorienting global finance towards climate and the SDGs. I will end here, but I would say that in South Africa, with the new political partnership in place and the perspectives of other countries to join, I hope, with the number of public development banks operating here, with all the possibilities that are opening up for greater involvement of the private sector, and with the so many famous researchers, together we can contribute to close in South Africa both the alignment gap and the financial gap, and maybe inspire other countries. Many thanks to you all, and I stay for questions if you have.
Thank you, Audrey.
Thank you.
That's really helpful. I'm not sure if we have Anna online. It seems like we might have lost Anna. Anna, are you still there? Yes. You are.
Oh,
Okay.
I'm still here. Apologies.
Good news.
Mhm.
Yeah, thank you. I'm going to ask you to provide your input, and then we'll have a couple of rounds of questions. Thanks, Anna.
Okay. Excellent. Thank you. First of all, welcome everyone, and thank you for an opportunity to be here with you. Let me just make sure I get the presentation right. Can you see my slide now? Can you just confirm?
Yes, we can. You are on presenter view, but we can see it.
Mm-hmm. Okay. Okay. I think I will stay with that view as that seems difficult to be fixed right now. Okay. First of all, I'm Anna Chmielewska. I'm leading the energy activity in Central Europe in terms of EBRD operations, and I'm happy to provide you with some examples of what we can what EBRD has done so far. Just before we have heard a lot about the just transition concept, and indeed we as an IFI are also committed to the idea of just transition. Very similarly, as was mentioned before, we understand this concept. We actually has launched our Just Transition initiative in May 2020, where we made it clear that the energy transition and the overall transition to low carbon economy remains the top priority of the bank. But that transition should also take into account the social aspects, which would allow to ensure that the benefits of that transition are shared within the wide society. So protecting vulnerable countries, regions, and not leaving any significant groups of people behind. And in this respect, the bank involves both in the policy dialogue, where we work with authorities of different regions or countries in helping them designing the appropriate actions plans and appropriate measures to ensure that, as well as working on specific opportunities. And two examples I will give you right now. One of the first initiatives that had a link to Just Transition was actually our involvement with one of the large utilities in Poland, which has significant coal legacy. The company has the majority of its energy mix is hard coal, as for the whole Poland. The company is located in Silesia, the largest Polish coal regions. So the company is a classic example of a company that needs a change. For a long period, the company has negated the change, but luckily a few years back, they've actually decided to follow the global trend. They realized the only way to actually operate in the modern world is to significantly change their strategy. And they announced, was roughly 2 years ago, they announced a strategy where they committed to the public that they will be aiming to reduce their carbon footprint by half by 2030. That was the step where we started considering engaging with that company more broadly. It wasn't yet the sufficient argumentation for us to help them in raising financing, but we started to work with the company to understand more details of how that would be achieved. The company was seeking significant financing through a bond issue where they were willing to put some environmental KPIs into the bond conditions, including emission reduction and increase of the renewables capacity. In this respect, so that these were the commitments to all investors. What we followed up on to actually help the company to complete that financing and to involve as a kind of anchor investor in that issue, especially as the issue was planned during the escalation of the COVID crisis, where the financing market was very uncertain, was that we actually discussed 3 distinct areas of involvement with the company. We discussed with the company the key areas of the key operational steps of the strategy, including the intermediate steps of the coal phase out, where the company committed literally to phase out roughly 1 gigawatt of hard coal capacity within the following 2 years, as well as longer term targets. We have clearly ring-fenced both the bond proceeds and EBRD proceeds for the specific proceeds where the bond proceeds were completely ring-fenced from the coal assets, while EBRD proceeds were clearly linked to new investments in grid, which is not only necessary for Tauron itself to expand renewable capacity, but also for other players active in southern Poland to be able to connect their renewable energy sources. But what we also did to make the transition of this company more viable was we worked with the company to make sure that they will also address the labor issues, because the union's actions could be really distorted, especially in what is the coal region. So we have actually encouraged the company to have a closer look into what they can offer to their employees in terms of reskilling, so that people who used to be active in the coal segment can then find their new way into either the new Tauron group after the changes or outside in the market. And this way, this project contributed to this just initiative. The other example of our Just Transition initiative was our work with the city of Wałbrzych under what is called the Green Cities program. And here, Wałbrzych is a relatively small city of just over 100,000 inhabitants. The city has significant coal legacy. It used to be a mining city with mines being closed more than a decade ago. But still, until very recently, the city wasn't able to recover from those coal legacy. And that's why, in the context of what other cities would face shortly, not only in Poland, but also elsewhere in the coal regions, we thought it's extremely useful to demonstrate a positive case of the post-mining city actually finding a new life and a new way of functioning, attracting business, attracting people. And this is where we work with the city by providing them financings for their infrastructure investments, which were aimed to make the city more integrated, both regionally and internally, also to have the to reinforce the inclusion angle of those areas which were not really benefiting from the wider economic growth, as well as on the thermomodernization of some of the buildings. But we also have assisted the city with a grant money from the donors and are working with them to develop what's called a Green Cities Action Plan, which is a set of investments for the city to consider and to review that would allow the city to be more aligned with the low emission economy principles and become more inclusive. This action plan in the context of this particular city also incorporates just transition elements, so puts the social aspects on the very front to address the legacies that were before on the related to the mining history. So that's the way we can work with the cities. The other instruments that we use to promote low carbon economy is our active involvement in promoting green bonds and sustainability linked bonds in the countries of our operations, where these are only the sort of initial issues. And here, very briefly, the recent example is the bond, sustainability linked bond for PPC, which is a Greek power utility, where although the use of proceeds is really for refinancing of the existing debt, what gave us comfort to support this company was their very ambitious target when it comes to converting that business model. This company has actually committed to reduce their carbon footprint by 40% within mere 2 years, so by the end of 2022. And this was achieved thanks to also the commitment of the Greek authorities to actually very quickly decarbonize and phase out coal assets in the country. This was the first sustainability linked bond externally certified in EBR, this country of operations, effectively proving that this new instrument, which compared to green bonds, promotes more shift in the company's strategy rather than promoting specific investments. It proves quite important also in maybe a little bit less developed parts of the world. Here we are talking about Greek markets, so one of the most advanced markets in our geographies, but we clearly see the trend is coming and more issuers are actually contemplating this type of investments. So just to summarize, a key takeaways is that to achieve just transition and to achieve energy transition, we believe it's critical to involve the key players in a given market as well. Frequently we see, newcomers being vital to energy transition, and it's true, we don't contest it, but we need to also make the established players to follow the trend to make the impact at a scale. So therefore, it's important to work with local large companies, with local authorities to help them shift their thinking and become aligned with green economy principles. It's very helpful if there is a support from the country level policies. and those large players have a clear impact of what's happening in the country. So there is a mutual synergy, and if those two go together, really wonders can be achieved. The primary strategic objective is that we try to approach and communicate to our partners is that, you know, it's very important that while, you know, everyone agrees the common goal is a low carbon economy, it actually is very useful to evidence that it actually also helps the future financial prospects of a given city, of a given region, of a given society. And this link makes the financing possible. The social aspects, as was mentioned before, remain important and shall not be forgotten about. So that's really from my side. Hope, you know, these 3 examples give some hints of what can be done with those large players.
Yeah, thank you very much. So I'm conscious that we only have sort of 10-15 minutes left. So I'm going to ask a couple of rapid questions and invite any of the panelists to answer, and including you here, Olympus. So I guess, you know, I think Matt, you talked about two parts of the equation. There are those companies that need to reform. It's because of global commodity market changes, the risk sitting in the coal sector, petrochemical sector, that tends to be where we focus. But then you also mentioned this other side, and a couple of other of the speakers also talked about that, is the stimulation of new industry and new sectors that aren't in those traditional sectors we know about. We know we need to engage on energy. We know we need to engage in cities. We know we need to engage in transport. But what are the other areas that we need to think about stimulating? And I wondered if you could talk to that. And maybe what I'll do is do just a quick round. You can have a minute each, but really just, you know, how do you get new into the economy? How do we be innovative? How do we be creative? Olympus, I'll give you a minute to kick off.
Thank you, Steve. I think from our side, just to answer your question differently, we see a big opportunity in terms of how we utilize our product offering, especially from a project preparation point of view, to say, when we start early engaging with project sponsors, what is it that we can do to redirect what needs to be done to take into consideration the pressing issues that we are talking to today? Because at that early stage, it is possible to then, through your engagements, ensure that the way the project is going to proceed from then onwards takes into consideration the challenges that we are talking to. And we really believe that is an important consideration that is going to inform the outcomes and potentially the structures that we are going to look at in taking the projects forward. So we think that creates a significant opportunity for us to use the instruments that we have and direct the discussions in the right direction.
Yeah, interesting. I mean, to some degree, you're still dependent on what's there in the project pipeline. But maybe, Audrey, you can pick up on these thoughts.
Sorry, do you hear me well?
Yes, perfect.
I just want to add a little point, because here from AFD, we are working with the South African presidency in providing analytical tools. We have a great collaboration in the area of research and analytical tools to provide those most heavily impacted by the transition with alternative opportunities for sustainable livelihoods. And it's a full analytical support that helps identify what is new, what are the new opportunities to be developed, and what are the new skills that are required, and the whole investment that comes with it. So this is something we are developing with the presidency here.
Interesting. Yeah, love to hear more about that. Anna?
Yeah, well, I would like to add and underline that at EBRD, actually right now across all sectors, we take the low economy principles, low emission economy principles into account. So whether we work on on initiatives in the financial sector. We focus on giving the right priority to financial activity in the areas that are aligned with Paris Agreement, that are aligned with the concept of green economy transition. When we talk about the production industry, we look carefully how to minimize their carbon footprint, how to streamline the processes, maybe even to sort of amend the product mix to make it again consistent with what we see a few steps ahead of us. Clearly, it's, when we are talking about infrastructure, energy, the aspects are more tangible. But even when we are working with private equity funds or even with the venture funds, their activity is quite frequently linked to these new segments and effectively streamlining capital into those new sectors remains important. It sometimes requires more risky capital, frequently requires equity capital, frequently supplemented with grant money as well from other sources. But these are the areas that we feel are important, as you rightly pointed out in the introduction. Very frequently, this innovation angle is important. That said, we shall not overweight the value of innovation and should not wait for the outcome of innovation to actually save us from higher emissions. So I think we need both legs. We need the innovative technology, new investors, new standards to come into the market, but we also need the legacy to be managed over time to reduce the carbon footprint already existent, especially in the countries that are sort of already, let's say, relatively better off. It might not be possible everywhere, but where it is possible, it actually currently already makes not only sense from the perspective of emissions, but it also makes economic sense for the future competitiveness of those players.
Thank you. I mean, I think this point about competitiveness is key. Matt, you gave a pretty wry smile when Anna mentioned overweighting innovation. So I'd be interested in your thoughts on that. But perhaps also if you can share with us when you did that South Africa analysis, whether you did identify areas outside of the sort of vulnerable fossil fuel sectors that would look good for investment.
Sure. So, I mean, I think low emissions needs to be the baseline, really, right? So if all of these areas with significant growth potential are low emissions, then there's the question of, where are the areas where South Africa is particularly well placed, and what are the technologies which, in the international context and in the local context, are great opportunities for South African industry. And the answer to those two things might not be the same necessarily. I mean, just coming back to the research, I mean, we looked at a series of the kind of metal-based, primary metals that South Africa produces, which were, potentially likely to expand significantly in demand in the transition, right? And that remains the case. I think the picture for platinum is probably a little bit uncertain, depending on what happens with which battery or fuel cell technologies end up really gaining a lot of popularity. But then one thing that we didn't think about really to any significant degree back then was the opportunities in green hydrogen and the production of synthetic fuels, and really kind of repurposing existing valuable assets that, like Secunda, for example, that have the opportunity to produce those sorts of things. And my sense is that the international trends at the moment are probably clearer than the ones in South Africa, because South Africa has been, as you will know, has been stuck a little bit with Eskom for a while, and there hasn't been too much policy certainty about which technologies are going to be favored in power and in transport and in industry. But you know, things that we thought would face downside risk then, like steel, for example, I think there's really an opportunity if they can be converted to green related things. So, you know, on the question, I mean, my wry smile, I think, was about just more coming back to this question of, you know, low emissions versus low risk and or, you know, significant upside in the transition, because I personally, I think that targeting emissions per se should be an outcome of targeting, you know, industries with sustainable growth profiles. But I think, you know, the opportunities for financing clearly there, but understanding those industries and targeting the particular niche that a DBSA might play, or a DBSA in collaboration with an AFD and an IDC, for example, you know, in terms of gaining the biggest impact.
Yeah, thanks. So many more things that I would want us to touch on, but unfortunately we're out of time. I would love to talk a bit more about how you kind of blend in private sector finance, how we move at a speed that is appropriate to the needs. So I guess one of the big challenges from the private sector side when working with DFIs, and particularly long-term big DFI funds or climate funds like green climate funds, is the time it takes to get things through the system. But unfortunately don't have too much time to deal with that. So I'm going to give the last 2 minutes to Olympus, just to maybe also talk a little bit about the question Matt asked right at the beginning, is DBSA's role in Africa, and then also just to close for us. But from my side, thank you very much to the panelists. Thank you, and I thank you, Audrey. Thank you, Matt. Appreciate your time and your input, and look forward to engaging in other sessions in the future.
Thank you
very much.
I think just last few words, Steve, especially with regard to our strategy around climate financing and how we use that on a regional basis. Our idea is really to look at financial solutions that talks to understanding the direction from an NDC point of view per country, and how we respond to that, you know, accordingly. And, you know, that often is challenging because the direction for the various countries would not be the same. And when you want to respond to that in a programmatic manner, you really need to be engaging with the stakeholders within each of those countries and understanding where they need to be going, but also aligning that with your own mandate, also understanding country risk and what is possible to do for you as a DBSA, because in many cases where we source these climate funds, for example, from your GCFs, there would be an expectation that we co-finance from a DBSA point of view, therefore bringing in significantly alignment with DBSA mandate. So you look at various things, our mandate, the mandate of the GCF, where the country seeks to go, and how we effectively, you know, support, you know, the implementation of their NDCs. But that's really what we are grappling with, and you know, hope we will be able to respond to effectively, especially as a direct access entity of the GCF in the region. Thank you, Steve.
Thank you, everyone. So thank you for that session. Really appreciate everybody's input. We have a rapid fire session for the rest of the afternoon with 3 quick interventions on investment opportunities in South Africa. All really interesting things. Maybe just as a teaser to get you to stay for the last session is looking at green iron export out of South Africa, an opportunity for both improving competitiveness, which was raised by this panel, but also creating investment opportunity and local social impact. But that is the last of 3 excellent interventions, and we invite you to stay for this quick hour and a half rapid session. But I'm going to hand over to Ritmetsi to introduce the first session. And thanks again to my panel. Bye-bye.
Thank you very much. Bye-bye.
Thank you.
Ready to go? Thank you very much, Steve. As Steve has mentioned, this is part of kind of the last set of presentations and discussions that are focusing on the just transition and also around the finance components and how do we bring together stakeholders, finance, and all of those other elements that are required to make the just transition occur in South Africa. We will now be having Ms. Priscilla Mabelane, who's the Executive Vice President for Energy at Sasol, who's going to be joining us to speak to the key success factors for decarbonisation and sharing her thoughts and insights in this very short 30-minute session. Ms. Mabelane, you're welcome to come forward. Can I move this or there's a, do I need to look at myself? Just move it to the side. Don't try to. Oh, that's it. Can I do this? Huh? Thank you. Ritumet. Okay. Thank you, Ritumet. Good afternoon, ladies and gentlemen. Thank you for the opportunity to address you today. So over the past few years, we've had ambitious commitments and pledges made by governments, major corporates, including ourselves as ESCOM and the society at large, to decisively tackle the climate change opportunities and challenges going forward. It is critical that the global community collectively seek to transform economies in a way that enables a sustainable and inclusive energy transition. The World Bank reported in 2019 that there were still 759 million people globally without access to electricity, of which 634 million are in sub-Saharan Africa. For a developing country such as South Africa, we believe that the transition to a sustainable future must be just as we pursue decarbonization pathways while protecting our communities. Sasol supports the South Africa's NDC fully. Having placed climate change at the center of our strategy, we have committed to bold targets that will enable South Africa's NDC. This includes reducing our Scope 1 and Scope 2 emissions by 30% by 2030 and achieving a net zero by 2050. It is critical that the country progresses towards these commitments in a way that takes our national context into account, balancing the pace of the decarbonization while ensuring our communities are part of the transition. Meeting the NDC must be underpinned by measures that are beyond mitigation and adaptation. We need to ensure we have technologies as well as enabling policy regulations, as well as much needed finance. Today's sessions have covered a lot of this, but I'll give some context to it as well. The strategic context is vital to South Africa's decarbonization agenda. I must commend South African government for setting the scene for all real players to come together and take tangible steps in tackling climate change. Although much work lies ahead of us, there's significant progress been made. We as Sasol, we believe our experience in running complex supply chains and unique technology advantages are assets that we can leverage on in playing a leading role in the country's energy transition. To that extent, we are proud to have partnered with South Africa to be a critical player in the energy evolution. As has been articulated by various speakers over the past few days, there are many enablers required for the successful and sustainable decarbonization of the economy. Hydrogen is a key lever in enabling all decarbonization pathways and is critical for ambitious NDC commitment. Today, let me share our perspective on some of the key success factors for unlocking Southern Africa, and we emphasize Southern Africa because we believe this opportunity is a regional player. As such, the first opportunity really is around the National Green Hydrogen Strategy with clear targets. South Africa is in the process of developing a national green hydrogen strategy, which will encompass a number of strategic frameworks underway. Progress has been made with the Northern Cape Hydrogen Strategy, as well as the Hydrogen Society Roadmap to move South Africa ahead of the hydrogen development curve. Nevertheless, these initiatives, while are precursors for the development of the National Green Hydrogen Strategy, it is important that we've got a clearly articulated commercial strategy and a roadmap to deliver the strategy. This will be critical for South Africa to build a sustainable competitive advantage and robust value proposition for the long term. To give an example, we see the opportunities in terms of export for hydrogen for the region to be circa around 4 million tons to 8 million tons, depending on the scenarios that you're looking at per annum going forward. Secondly, we need to build sustainable ecosystems and partnerships, which will be key to anchor local demand and accelerate the provision of sustainable energy solutions. As the world decarbonizes, the competitiveness of South Africa's export market will be challenged due to the high carbon intensity of the energy mix today. At Sasol, we have been engaging with a number of our customers to understand their challenges, their pain points, and the opportunities to meet the global competitiveness of providing sustainable solutions to their customers. To that extent, we believe that South Africa will need hydrogen-based solutions for various sectors that Sasol is well positioned to provide. National and international collaboration will be essential to building such sustainable hydrogen ecosystems. Our ambition is to create South Africa's hydrogen ecosystem through strategic partnerships, leveraging our proprietary technology, which is our Fischer-Tropsch technology, and our experience in integrated value chain. Nationally, Sasol has already established key partnerships that will contribute to stimulating activities in the hydrogen economy, such as in mobility. A lot has been said today about the decarbonization of the heavy-duty mobility, mining, green steel, how we revitalize the green steel industry, auxiliary power, and sustainable aviation fuel. Furthermore, public-private partnerships, like what we have established with the Northern Cape that was announced yesterday, and the Gauteng government will seek to stimulate developments of these industries through specialized economic zones. Internationally, it will also be critical to establish partnerships to secure long-term offtakes for green products. I cannot stop emphasizing the importance of offtake for green products, particularly to ensure the economic viability of these projects, especially for greenfield developments in the early stage of the hydrogen technology development. Further, global collaboration to form technology and R&D partnerships will also be key to lowering the levelized cost of hydrogen and related technologies. At this stage, we do believe that technologies such as electrolyzers, direct air capture technologies needs to come down significantly. And to enable the acceleration and the commercializations of such technology and to drive costs down, South Africa needs to be the heart of the development of such innovative technologies. Another factor is access to affordable funding at scale, including grant funding. Again, this is a topic that has been covered significantly today. As a developing nation, South Africa needs access to affordable financing to enable our transition. The financial commitment needed for the energy transition is substantial. As an example, to capture the full extent of the hydrogen opportunity will require approximately $5 to $10 billion, depending on which pathway and scenario you're looking at, per annum on an annualized basis. This is in addition to the $7 billion per annum required to decarbonize the power sector. The $8.5 billion facility announced last week by President Ramaphosa is indeed a step in the right direction. However, it will require a transparent and innovative allocation and governance framework to prioritize key sectors that are foundational and critical to the energy transition. And that needs to be done in a manner that takes into consideration the just social compact that the private sector and the public sector can develop jointly. And at Sasol, we believe we are well poised to be a part of that. Beyond this $8.5 billion facility, more funding will clearly be required. To secure these funds, collaboration of DFIs and commercial banks was good to hear today, the Development Bank talking about that, would be essential in addition to multilateral discussions that have happened. Funding secured must be affordable and comprise a range of instruments from grants, concession debts, direct equity, and debt investments. Grant funding is even more important as we get into some of the greenfield projects that will require a number of investment in feasibility studies as well as development studies. And some of those projects has to be driven in a way that we can actually take advantage of South Africa as well as the region first mover advantages. The other factor that I wanted to cover today is around an integrated infrastructure development plan. This is key going forward. The scale of the infrastructure requirement that will be required to meet the hydrogen ambition will be transformational for the economy and for the region. Again, public-private partnerships would be necessary to meet the scale and timelines of the required infrastructure for rollout. This includes access to deep water port infrastructure, to access new export markets. As Sasol, we are already leading with global partners such as the Port of Rotterdam to start establishing such partnerships, and the timely deployment of grid infrastructure solutions for both the power sector and the hydrogen economy will be important. Similarly, the infrastructure plan should define the regional hydrogen transmission and distribution pipelines required across the ecosystem. To give an example, most of the opportunities for the development and acceleration of hydrogen development will be based in the coastal, while at the same time, the demand for such green hydrogen will actually be inland based. So we do need to have effective and timely hydrogen pipelines to be able to transition and transmit the hydrogen from the coast to where the demand will be centered. Lastly, enabling policies and regulations will be key to accelerate the just transition. And just to pause on this one, I think the last few days, it has been interesting to listen to all of the dialogues against what is really needed in terms of developing an integrated skills development plan and a change management approach to ensure the workforce transition for the country. And this is important because to ensure that we've got a smooth transition of the skills of today to the skills of the future, we have to do this in a deliberate and a thoughtful manner. Similarly, inclusive growth is a must and should be done with a deliberate plan to maximize industrialization. And these initiatives must also accelerate job opportunities for the marginalized communities, such as the youth and women. Again, I want to emphasize this. It will be unfortunate if the just transition does not address the challenges that we believe the region is facing in terms of the differentiations between the youth and the women in the energy sector. Regulatory consistency and coordinated projects approval are also essential to stimulate market activity and surfacing each project opportunities. Government's leadership role is key to set up such strategies and targets to provide frameworks for the country to decarbonize. We're seeing that the global and developing markets are taking a lead in developing clear pathways as well as the regulatory mechanisms that will enable the decarbonization agenda. The region is lagging behind in terms of such developments. And we do believe that the partnership between us as an industry, government, and in addition to the strategy I've already articulated, needs to be clear to co-create an enabling regulatory environment and policy framework to accelerate the development of these low carbon industries. For example, driving international advocacy on key topics such as carbon accounting to ensure products meet green certification standards is going to be quite critical. Also to mention, the journey towards the decarbonization agenda will require the region as well as South Africa to have a clear strategy and plan towards carbon tax and how it will be effectively be utilized to decarbonize the economy and support the industries that needs decarbonization support. These key success factors reflect what we believe is necessary for decarbonization and to capture the green hydrogen opportunity. The journey is exciting as we shape a new sustainable future for our children and the generations to follow.
It is in our hands, and I hope you will join as we innovate for a better, you'll join us as we innovate for a better future and a better world. But I need to emphasize that all of these discussions has to be underpinned by deliberate, thoughtful plans that are driven at pace by the society at large, and the corporate or the private sector needs to be at the heart of driving that jointly with government. And I hope that as SASOL, we have demonstrated our proactiveness in shaping the strategic relationships and partnerships between ourselves and government in a number of the initiatives that we've been announcing in the last couple of months and today as well. And I thank you. I don't know if there are any questions, and okay. Thank you all for that, and looking forward to the next debate as well. Thank you.
Thank you very much to Priscilla for sharing those thoughts and insights on those key success factors for decarbonizing South Africa's energy sector. I really do concur with you that it's important from the perspective of building those partnerships to make sure that we are able to achieve the transition and to make sure that we leave no one behind. So building in the considerations of our broader society and understanding some of the challenges that we face as a country, and really taking this just transition as an opportunity to address those challenges in how we progress. So we're going to continue with our session of rapid fire sessions, where we're getting some insights from leading companies active in South Africa's economy and how they are tackling the just transition. I'm going to hand over shortly to Mr. Mzila Mtajane from Exxaro, who will be speaking about Exxaro's strategy and the specific approach to tackling those challenges around the just transition. Mzila, I hope you're ready to share your thoughts and insights with us.
Good evening, ladies and gentlemen, and thank you very much, Ritumesi, for the introduction. I think there could not have been a better opportunity to come and present Exxaro's strategy than this opportunity at this COP26. So maybe I can start by introducing Exxaro and giving a high-level view of who Exxaro is. So Exxaro Resources is a coal mining company. And let me pause to see if there are any tomatoes being thrown at me at this point. So I'm safe so far. So we're South African based, and we supply Eskom as one of our largest customers, as well as export coal. About 25% of our coal is exported. We're a critical player in the South Africa's energy value chain, supplying about between 30 and 35% of the coal that the country needs for the generation of its electricity. And so we take our role very seriously. But needless to say, with the event of climate change, we had to think very, very clearly and strategically about where our future lies. But in thinking about that future, we had to start from the base of where we're located, who we are, being a South African-based company where electricity is predominantly generated from coal. That being the case, then, we saw this as an opportunity rather than perhaps what others may have thought to be a threat in as far as where we could potentially go as a company. And this is where our sustainable growth and impact strategy comes in. In terms of who we are driven by our purpose of powering better lives, and not only in South Africa, but in the rest of the continent. And this is a perspective we've had dating back to 2016, 2017, in terms of where we saw the need to be able to power the continent of Africa and where we saw the needs, the future needs of the continent would be. And from that, we developed our vision of how we'll be a company that powers a clean world, that will develop resources that will power a clean world, guided for our sustainability by our values and our resilience as we navigate this future through our culture. And so the forces that have been shaping how we've been thinking about the strategy have obviously been around, what this whole climate change is about. I guess it would mean different things to different people. But how we saw it was that it would increase these scarce resources that we need, but also the scarce resources needed by our communities, such as water and other natural resources. Secondly, there's no denying that there is a need for energy transition, looking at the impact that the increase in temperature is having, not only in South Africa, but around the world. And this global move for an energy transition is one which we cannot shy away from. Recognizing the need for this energy transition, we acknowledge the impact this could have on communities, particularly those vulnerable communities that depend on a company like Exxaro and the whole value chain of the coal mining industry in South Africa. And so in designing our transition, we designed it such that it would have, and it should have, a positive impact on communities. As a coal mining company, we recognize as well that the assets that we manage do not belong to us. We are stewards for responsible value creation for all our stakeholders. And so in essence, we were given three choices, and different companies have chosen or have taken different options. We chose to manage our assets. As I've said before, we're an important player in South Africa's economy and its energy, and hence the choice to manage these assets. And fortunately, given the quality of coal resources and coal reserves, it was not a very difficult decision to make. And out of this then was born the Exxaro strategy, which is guided by our 5 strategic objectives. And we interrogated these and reflected them against what often people refer to as ESG. And there's a resonance between these 5 strategic objectives and ESG. And the expression sustainable growth and impact was a deliberate choice of words, in that the strategy needed to be sustainable, given the context of climate change, that we achieve carbon neutrality by 2050. And that as we transition and pursue this low carbon growth, we manage our resources such as water very efficiently, not only for our benefit, but for the benefit of our communities. And at the same time, ensuring that rather than resulting in biodiversity loss, that we actually manage our operations in a way that results in biodiversity gain. And the relationship between climate change and biodiversity is one that we recognize. From a growth perspective, we're pursuing a low carbon growth. And this is not only in terms of the development and investment in our renewable energy business, but the minerals business, which we're planning for beyond coal in terms of our investment in manganese, copper, and bauxite. And combined, this low carbon growth and the sustainability needs to ensure that it results in resilient communities. As a company, we've been developing our sustainable strategies since the inception of Exxaro in 2006. And so when the rest of the world caught on to ESG, for us, sustainability was just a way of work and a way of doing things. And so the just transition for us really presents more opportunities for the company to succeed in an environment which will be thriving in as far as our communities are concerned. And so from a mining perspective, typically, the mine is placed at the center of the community. And what we've seen from this is that this creates dependency of communities rather than effectively empowering communities to be able to sustain themselves beyond mining. Our vision rather has shifted to making mining a catalyst And you would have seen from one of our strategic objectives that we envision ourselves being a catalyst for economic development and environmental stewardship. And so the difference between this picture that you're seeing on the screen and the one before is how mining has shifted in the background on the top right-hand corner of this picture. But the impact that it has had is what you see in the foreground, where mining has played an important role in terms of developing new industries that will sustain communities beyond itself. And this, in essence, is what we're talking about in terms of what a just transition, and in our case as Exxaro, from a coal mining company to a company of the future. This is what we expect mining to play a role in our communities. And so the vision that we have developed has not been one that Exxaro has dictated, but it has been developed from the ground up through extensive consultation with communities and employees in both existing and some of our operations, which have been under closure, to understand from these communities how they have been impacted by mining, what their needs and expectations are, and in fact, what's most important, what their vision for the future is. And so with the understanding that we've developed of what the just transition is about, this is what we've arrived at. It is not only about energy transition and investing in renewable energy, but the just transition needs to be able to incorporate in new initiatives, in new industries, all these requirements which will achieve economic benefit, they will achieve social benefit, as well as ecological requirements. And more importantly, the governance of how these projects are going to be implemented is going to be critical. And it's going to be the combination of one or more of these requirements that will actually ensure the sustainability of these projects and the resilience of these communities. This is where we speak largely of the science-based and nature-based solutions. And so what this diagram represents is how we've been thinking about the approach to all of these projects. When you look at the diagram from the left-hand side, and if you also able to at the same time look at it from the right-hand side, it converges in the middle. So on the left-hand side, we have to address the challenge and the opportunities of climate change in order to enable carbon neutrality and eventually net zero growth. But on the right-hand side, we also have the challenge, and this is not unique to South Africa, but to many other developing countries, of reducing inequality, creating employment opportunities, and empowering particularly the vulnerable and rural communities. And the just transition is giving us an opportunity to really be creative and innovative in terms of how these two themes come together. So looking from the left-hand side, we start off from a position of and a perspective of water security, and how with water security that provides opportunities for additional work in as far as biodiversity and conservation. And this really highlights how critical water is in this whole effort. And that then results in other opportunities where you have water, and you would have heard was a lot of discussion earlier, particularly from Kolisi Masio, around the repurposing of mined and mining land, regenerative agriculture, which in itself will contribute to creating carbon sinks and hence contributing to a further positive impact on carbon emissions. And then looking at the diagram from the right-hand side, is that we've been on this digital transformation for quite a while now. And what you see from the diagram is that the opportunities in embracing the digital economy is that it begins to empower communities and business with transition skills, varying from not only being able to mine in new forms of agriculture, but also in new industries that we can invest in through enterprise and supply development. So small scale or SMMEs are going to be a very important part of this whole thinking. The green economy combined with the technology is going to be an opportunity for huge benefit for communities. And I've mentioned already SMMEs. And then circular economy from a waste generation or waste management is also another opportunity. And so these come together in the middle to create several opportunities, which are shown in the next slide, which I won't go through, but through all of them. But you can see from water security in terms of how, as a mining company, for instance, with recycling of water, with construction of water treatment plants, we're able to reuse water and therefore use less potable water. And in that manner, being able to give back water to communities. In an environment of climate change where water scarcity is going to be a norm, I think the efficient use of this resource is going to be critical. A simple project such as the clearing of alien species is very important in what you may not appreciate to be water production. Alien species are a huge consumption of water. But what is also important is what you do with those alien invasive species, such as the trees. This can result in new economies in terms of what you do, and very sustainable economies. We've looked at several projects, and we continue to look at several projects that we believe will be viable and investable, and will fall into the criteria that are listed earlier. But also yesterday you heard about the NDCs, and earlier today about the kind of projects or criteria that have been looked at for these new types of projects. And all of these initiatives that you're seeing being listed here, to a greater extent, actually meet a lot of these criteria. And this for me and for the companies presented very exciting opportunities to see these projects getting on to the next phase. I must emphasize the last block on blockchain-enabled impact, despite what may seem to be a very complex technology. But what we've learned is that it enables transparent measurement of the impacts of each of these projects. Through this technology, one is able to ensure that any benefit, financially or otherwise, actually flows where it is meant to. And secondly, it has a huge enabling mechanism in terms of its simple access and usage by community beneficiaries through simple telephone technology to be able to connect directly to where where the technology is developed. And so we're quite excited about this thinking that we have developed in terms of the whole approach to the just transition, but more specifically, the kind of projects that will originate from this new type of thinking. And so the next slide really highlights, just by way of example, potential project. It may seem complex, but this is starting from the concept of water security, where we are investigating a rain enhancement technology. It's a proven technology, and it's unlike some of the technologies that may have been seen that depend on chemicals. This one does not depend on chemicals, where we see potential increase in rainfall of about 35%. But that's not where the opportunity lies from a socioeconomic development. It's then what happens when the rain hits the ground. You immediately get the recharging of underground water, availability of water, which then begins to create opportunities for agricultural investment opportunities, as I mentioned earlier on. But it's not just any type of agricultural activity. It's a type of agricultural activity that results in growth of new types of species of food. And what I mean by that is indigenous food. But being conducted in a regenerative way, it means that it is a type of food product that can actually attract a premium in the market. And so the combination of a water project such as a rain enhancement really becomes that catalyst and results in then additional economic opportunities being developed from that. And then a number of projects that I can talk about, but I think the previous slide highlighted the kind of projects that are possible. I cannot as yet share the breadth and scope of all the projects that we've been working on. There's still an internal process that we've been going through as a company. But I'm hoping that in due course, we'll be able to share these, but suffice it to say that these are projects which we believe with perhaps a little bit more time and effort and bringing in other collaborators, we'll be able to develop them and be able to raise some funding and get access to that $8.5 billion that was announced earlier on. This is an example of the impact of that water and rain enhancement project, which was implemented in Jordan. The left-hand side of the slide shows the before picture, and the right-hand side shows the after picture. And for those who know Jordan, it is amongst the driest countries in the world. And this is the kind of impact that technology and innovation can have. This is South Africa and how and where we are thinking of implementing the technology. So what this is really showing is where we've identified potential sites that we can impact. Some of the sites in South Africa are sites which will be impacted negatively by climate change as a result of increasing temperature and drought. And what we're showing is the impact in terms of number of people who could potentially benefit from this. And this is really for us what has been critical about our strategy. That it's a strategy that is people focused and not only looking at technology, but looking at how technology can enhance the experience and how it can benefit people. So these are various parts of South Africa which will be impacted differently by climate change, to which we'll be responding to. And Exxaro has got operating mines in some of these, and in some of them we have mines which are under closure. The potential impacts, we've spoken about the more rain, and I think you'll see item 4 from a social impact is the agricultural output. This is, I guess, a generalization. So additional work will be required in terms of specific areas, in terms of what the potential outputs and impacts could be. And this will have huge impact on local as well as regional GDP. From a funding perspective, I don't think I need to speak anymore about funding. We've had extensive input in earlier conversations about potential sources and types of funding. And these are the types of projects that will be attracting that funding. We could not have come this far by ourselves. It's been a journey for Exxaro for the past 12 to 18 months. And you heard previous speakers speak quite extensively about the need for collaboration. And what we pride ourselves on as Exxaro is we've spent the past couple of years building a strength in terms of stakeholder management. And this has laid a very good foundation for us to then be able to build collaborative relationships and understand the requirements of being successful in a collaboration. And as you can see, there's quite a wide scope and variety of collaborators that will be required to make these projects succeed. And the importance of this is that it's about what each party can bring, not about each party bringing everything that is required for the success of these projects, including those who will benefit from these projects. And lastly, to finish off in terms of our strategy, that our vision is resources powering a clean world. Our outlook for Exxaro is not only in terms of our own growth, but rather the environment within which we'll be operating. We're looking at a company that will have both minerals and energy, a reduction and a contribution to the reduction in carbon emissions. Our outlook is also in terms of inclusion and diversity and inclusion. Whilst I may not have spoken about it earlier, is a critical part of our strategy and a reflection of the strategy being focused on people rather than just technology. And that impact at scale is going to be one of the our key measures of success as we transition to this low carbon future. Thank you very much, ladies and gentlemen. Okay. Questions?
So Mzila, thank you very much, Mzila, for sharing the Exaro growth strategy with us and giving us some insight into how you're tackling some of those complexities around the just transition. We do have the opportunity now to take a few questions. So I'm going to invite the audience that's joining in person. If you've got any questions, please just raise your hand. But in the interim, we've received a few questions from the online audience as well. Okay. So the first question, Zile, is to please give us a little bit more insight and a bit more understanding around how Exaro deals with air quality and greenhouse gas emissions, but perhaps focusing on the air quality issues.
We have our experts on the air quality, but it is something that we have sufficient resources for within the company, it is something that is quite pertinent to our overall environmental management program.
Mm-hmm.
And so whilst I might not be able to share all the details with you, what I can assure you is that, and this is something that we have disclosed in our integrated report, that air quality specifically, and in addition to that, carbon emissions are two areas from an environmental perspective that we give particular attention to.
Mm-hmm. So thank you very much, Mzila. Just to invite, I think, people who are joining us to also look at Exaro's report for more details on exactly how they manage those different issues. I'm just noting the time. Yeah, we'll move on to the second question that we've received from the audience on Zoom. First off, to say a great presentation. And the question is around the basis for the rain catalyst technology that you're mentioning, and clarity if that is cloud seeding. I think that the person who's asked the question feels that the technology has been tried and has been controversial in South Africa for so long. So
That's
perhaps
right,
just to clarify.
I can categorically say it's not cloud seeding, and hence our sense of confidence in terms of its viability. I think it would be contradictory to employ a technology that is as controversial as cloud seeding in a conversation about sustainability and impact. So no, it's not cloud seeding.
Do you have any more details around perhaps the general approach that the technology uses, just for some more insight into that?
I do, but I think at the moment I'm a bit reserved to be able to share that. I think perhaps what I can do is outside of this is give reference to where the person asking the question can see more of the technology and how it works.
Okay, thank you very much. So we
Thank
can
you.
share.
Yeah, I'll be able to share that
information afterwards.
Yeah.
Yeah. To the audience that's also attending in person, if there are any questions or any comments and thoughts that you'd like to share, you're welcome to raise your hand, and we can invite you up to please state your question. Okay. I'm not seeing any other questions, but to thank you once again, Mzila, and to encourage the audience, if they want to get a little bit more information, you're welcome to consult the Exaro integrated report, and specifically on the technology, there are some resources available that we can also share post this session. So thank you very much for joining this. I think this is the second last of our rapid fire sessions where the private sector has the opportunity as well to share in a bit more detail some of the initiatives that they're undertaking. Okay. So thank you very much, everybody. It's been a great pleasure to have you here today. So once we've just wrapped up that session, we'll be moving into our final session, which is looking at steel, green steel. And we have online colleagues from IDRI, so that's Mr. Hilton Trollope and Bryce McCall, who will be speaking a little bit more about how South Africa can kickstart the green steel opportunity that we have. I'd welcome you to please stay online for the next 30 minutes so we can get some insight into work that's being done in that area.
Hello, Hilton and Bryce. If you can hear us, could you put your cameras on? And there we go.
I'm going to invite the speakers who are joining us virtually to please put your cameras on and be ready to start the session. Okay. Thank you. I'll hand over to you.
Hilton, are you there? Hello, everyone. There he is.
Hello, everybody. Just 1 minute. My inverter that I'm using for load shedding just went beeping. I'm rearranging something here.
It's a very South African reality.
It went beep, beep, beep. Okay, let me just remove this window onto another screen and close that window. Get back to here. Okay, hopefully that works. That was some rapid reorganization. Okay. Can everybody at the session hear me talking about reorganizing things for load shedding?
Yes, we can, Hilton.
Yes, we see you and we can
I'm always
hear
a
you
technical
clearly.
problem, I'm sorry. Okay, well, luckily we're a bit early, but we're still going to try and stick to our time because it's been a long day. We've also got quite a technical presentation, but we'll try and move through it quite quickly and just raise the main points, technical points, the main summary points in the presentation, so that hopefully we can provoke some interesting questions, because that's where we think it really gets interesting. So may I share my screen?
Yes, you can.
Okay. Right. And here we go. And we hope it works with the recent rearrangement. Are you seeing my first
there you go.
slide? That's good news. Okay, so it's 10 to 7. I'm going to introduce the talk, then shift over to Bryce, and he'll give his input, then shift back to me, and I'll give my input and then questions. So what we're talking about here is green iron, which is producing iron fossil-free in South Africa. And we're going to look into the microeconomics, in other words, the techno-economic calculations showing that we think this is feasible. And then we'll look at markets, which would enable a bankable project. Just in a nutshell, this isn't a new idea. Australia, quite some time ago, started producing analyses about basically continuing to have an energy-intensive economy exporting minerals, but instead of using coal and gas and fossils, using substantial renewable energy resources. They have got it in a similar position to us. So we're not unique in this, but what we are, there's this huge opportunity. South Africa has amongst the best renewable energy resources and also very inexpensive land and minerals. And we believe that we can have a whole new prosperous era of energy intensive but green economic and industrial development. The overall question that we're exploring in this presentation, could we use our considerable renewable energy electricity potential to participate in overseas lead markets to start with? First, and the reason for that is we don't think that the South African market, especially for green steel, will be big enough in the next 10 years, but we believe we've got the resources to participate internationally. So first of all, Bryce will look at the techno-economics of iron and steel production, and then I'll look at markets. So I'm going to hand over to Bryce now. Thank you.
Thanks, Hilton. Just give me one moment to share my screen. Right. Yeah. Okay. Hello, everyone. My name is Bryce McCall, and I am a researcher with Energy Systems Research Group at the University of Cape Town. We started this work in the beginning of 2019, and we thought that hydrogen for steel and iron were a frontier of industry at the time, and it would be challenging selling the idea to anyone except researchers. Within 18 months with the project, it went from a tone of it's too expensive to actual large-scale commitments by the biggest companies in the world. It's moved very quickly. Today, I would like to talk about the technical work we undertook within our deep dive into green iron for export and the potential for South Africa. Just some technical bits. I will skim the very technical bits, but iron on Earth occurs naturally bonded with oxygen to form iron oxide, or we call it rust. To remove the oxygen that's attached to the iron, humans, intentional or not, discovered that heating iron oxide in the presence of carbon turns it into iron, and the carbon latches onto the oxygen and takes it away as carbon monoxide and carbon dioxide, and you're left with the metal. And so the rest is history. However, instead of using carbon to do this job, you can also use hydrogen in a very similar way with additional energy input. In our work, we used some literature-based studies and a number of resources to study how a potential hydrogen-based iron production facility might look like using a model. For our techno-economic work, we simply stick to the main components of a system. We keep the DRI shaft, the direct reduction shaft, the electrolyzer storage units, that would be hydrogen, and there's also battery storage we've included, and then adding a captive solar PV facility to this. So we're looking at a model of about 1 million tons production facility that's grid isolated, so that solar farm is the only source of energy for this facility. Just some background to some of the cost assumptions. We're looking at the year 2030, and we're assuming $20 per megawatt hour in 2030 in South Africa. Today already they've announced $25 per megawatt hour for utility scale. For storage, hydrogen-based storage is very critical in order to run a facility like this. The literature suggests about 500 today per kilogram, and we think it can go down to about 340 by the year 2030. And of course, using international sources for projections for costs on electrolyzers, the core component of this whole setup. And we run it through our optimization model. It's a times model. It optimizes on cost based on your techno-economic parameters. So the sun only shines during the day, and at night there's no electricity coming from the solar farm. And we use this platform to configure this facility for producing 1 million tons of iron per year, forcing the shaft to produce roughly in a similar fashion to today at about 90% of the year, so operating almost every day, day and night. And then the model, what it does is it optimizes based on these techno-economic constraints to size the storage, size the electrolyzer, and size the size of the facility, the PV farm. We find that a facility with an 800 megawatt electrolyzer and a solar farm of about 1.2 gigawatts, coupling to about 85 tons of hydrogen storage, could operate for most of the year at about 90% and produce that 1 million tons at about a little less than $400 per ton. If we compare that to today, that's in the year 2030, it should be cost competitive with the traditional routes of making iron. But all the components for this setup are internationally traded items. So why South Africa? You can get iron from ships from around the world that sell it on this open market. But Europe, or a place like Europe, is going to need all the clean electricity they can get to power all the other things in the economy that need to be decarbonized. This map gives an idea of the scale of the resources we have just on solar. We actually have a wind resource that complements the solar in the sense that when the sun starts to go down in the evening, the wind resources actually pick up and that complements electricity production fairly well. And it just so happens that we have a decent amount of minerals located in the same places as all this solar resource. So we have our main export of iron ore comes from Seshen, which is a mine in about here, and it goes along 800 kilometers down to Saldanha, where it is exported onto the international market. There's about 80 million tons that are exported through that facility. And at the same time, Saldanha Bay, just next door is the Saldanha Steel facility, which is owned by ArcelorMittal, South Africa, and it's an export-facing steel facility, which also happens to have a Midrex furnace, which is believed can be retrofitted to run hydrogen. It's not exactly clear, but that says a lot in terms of a small step to a long-term potential. And all the facility down there is steel producing and produces iron and steel. So it's all in one location, and it happens to be at the end of an iron ore rail. What does this mean for South Africa? I think there's a great potential for South Africa to utilize the minerals, the resources, and the industrial base to earn revenue, which could help with the declining exports in coal that's expected as the world tries to decarbonize. This will also contribute greatly to global decarbonization value chains, like decarbonizing Europe's steel value chain, as well as our local ones in South Africa, but in the longer term. And we think that this kind of idea of setting up a 1 million tons facility for export could start and kickstart the basis for decarbonizing global value chains and setting it up for decarbonization in South Africa in the long term. I'm going to hand it back to you, Hilton. Thank you very much, everyone.
Thanks, Bryce. Have you unshared? Can I try and share?
Hold on one sec. There we go.
Right, here I go. Share screen. Desktop 1, share. Right, are you seeing a slide that says Bryce's economic analysis?
Yes.
Great. Okay, so I'll just, Bryce, brilliant, a very difficult technical topic. Steelmaking is incredibly complex and the value chains are very complex, and Bryce has distilled that. So I just want to highlight one issue that didn't necessarily come through that strongly. The facility that Bryce is talking about, the 1 megaton facility, he showed you that there's hydrogen storage and a captive PV field feeding all the electricity that is made into hydrogen, all the other energy for making the steel. What that is that's a very worst case, most conservative setup, and it's deliberately not connected to the South African electricity grid for 2 reasons. The first one, we don't want to connect ourselves to success or otherwise of that grid for this analysis, for this illustration. And what we've shown is that purely building a new PV field and a storage, that we can export iron at a lower cost than it can be produced start my video. Oh, okay, sorry. With little funny things. There we go. Is my video going now?
Yes.
Yes.
Okay, so just recapping this, it's a worst case scenario. We can produce, we think, we've calculated, we can produce green iron not connected to the South African grid, a greenfield investment. And then there's another issue as well, and that is that the deemed emissions factor of a grid is the national emissions factor. So the minute you connect your steel factory to a national grid, if there's any coal or fossils on there, then that goes into the emissions factor for your green iron. So our green iron is pure green iron. It's absolutely fossil free, which makes it worth a lot more when you start using it in steel making. So I thought I'd just emphasize that point. Right, so what we're going to look at now is that's the techno-economics of production, but you can only get an investment for production if you have got a bankable market. And what we're saying is that certainly in the initial phases, the South African market won't be big enough, and neither will the African market. So to kickstart this and to participate in global sector decarbonization, we'll have an export market. And then one other point that Bryce didn't necessarily highlight is a lot of work has been done, and the cheapest way for global decarbonization is to split iron making and steel making. You make the iron where there's cheap renewable energy, and instead of exporting iron ore, you make the iron there where the iron ore is and the cheap energy, and then you export it to steel makers where you have all the different steel products in more developed markets. So just looking at the overall market, the global steel market context, you can see steel production has been growing significantly from 1950. There are times when it levels off, but it's growing up very fast. And then another important thing, global steel production is 1,800 megatons, not 18,000. But even so, South African steel production in that is 5 megatons of 1,800. African steel production, 17. So we are tiny little producers in a massive steel market. Chinese steel production is about 1,000 megatons. But even so, in this huge global market, demand is growing, and most of the demand, you'll see from this next slide, this slide shows in-use steel stocks. What that means is how much steel is there in your country per person. Most of the steel is in construction, in buildings and infrastructure, railways, waterworks, electricity, energy supply, etc., and then in vehicles and machinery. And you can see that in Europe and North America, per person, in-use steel stocks are between 10 and 14 tons per person. So that is the kind, and also steel is very difficult to substitute in the economy or in basic things like building buildings, building railways, building renewable energy systems like wind turbine towers, PV systems, etc., dams, highways, transport systems, very difficult to substitute. So to achieve a certain level of basic service provision and material comfort requires a certain amount of steel. So you can see the rich countries, 10 tons per person. China's got to about 6, South Africa's got 2, and Africa's got less than 1. So what this means is for South Africa and Africa to get up to basic service levels for really basic needs, a lot of steel still has to be produced from iron ore. So the market for steel is going to continue growing to supply even just Africa 500 million new citizens in the next 30 or 40 years. But we've chosen Europe for our initial kickoff market. And the reason we've done that is we don't think that the developing markets will have a big demand for green steel while they're still doing basic infrastructure development. there's a lot of material on markets. We've analyzed these. We've written a paper that's being finalized in a review in a journal. And there's a general agreement that in Europe, there's going to be a rapidly growing market for green iron. And that's because of European commitments to decarbonization. Both countries and steelmakers in Europe have committed. So we think that every indication that there's going to be a big demand for green iron in Europe, and South Africa can produce it at a lower cost than in Europe. The question is, why would Europe give access to South Africa, to its import market? Because that means it would be making less steel in Europe, and they also have issues of jobs in the steel industry, et cetera, et cetera. And I've highlighted some points from analysis of why this demand would grow. And the essence is, quite simply, for Europe to meet its decarbonization commitments, it's going to have to grow its renewable energy, low carbon electricity supply very fast. And they just have got limits on that. So what this analysis says is that the climate neutral basic materials industries will have to cover part of their energy demand with either imported renewable electricity, clean hydrogen, climate neutral synthetic fuels, or in this case, embedded renewable energy in, for example, green iron. And so for the transformation of Europeans' basic materials industries, Europe is going to need to develop partnerships with countries that can supply such renewable and climate neutral energy carriers. So what will be required here, both the necessities of European decarbonization, but also looking at those previous numbers, Africa 17 megatons out of 1,800 megatons steel. Bigger countries and steel makers are also going to have to consider global equity and justice. In other words, an international just transition, not just national just transitions, for smaller countries to participate successfully in global steel markets, and also for smaller countries and developing countries not to replicate the current underdevelopment in those countries, and for them to participate in industrialization in general. So this is going to require successful partnerships between developing countries and the richer countries, which we've been hearing a lot about at this COP. So what has Europe been doing? Europe has been proactively developing markets for these low carbon basic materials. And the way they do this is via what are called lead markets. And a lead market is much more than just a market pull. It's not just creating the demand side of the market, but it's an integrated coordination of a number of policy instruments in trade policy, economic policy, innovation policy, and industrial policy. Europe has done this successfully, and it's leading the world in both the demand side of green iron and in green iron production. And most of this production is announced. None of the first green iron was produced about a month ago, but most of this is using the technology that we are proposing for South Africa, and the one that we have a cost advantage in. So with lead markets, also there's a lot of work done on this. It's really deliberate, highly sophisticated policy by Europe. And it was done, for example, in photovoltaics. When photovoltaics started off, they were much more expensive than other options. Germany created lead markets for photovoltaics through its refits and energy portfolios and electricity renewable portfolios right through Europe. It brought down the price of PV, and the next thing, PV is cheaper than coal and gas. And this is, they're following a similar strategy for things like green iron. So, and part of their deliberate strategies, after you establish an initial critical mass in your domestic market, you then move into international markets. And that's, we want to join into this initiative. So what are the next steps? The first thing to implement demand side measures, we need to certify the embodied emissions in intermediate and end products, and this is happening. That's in the black text there. A lot of this is already happening. And why has South Africa chosen the specific export-orientated illustrative example? The South African industry basically faces an existential threat because it's floating around in that huge international market where there's a lot of trade wars between the USA and China and all kinds of things. There's a recent master plan for the South African electricity industry, but it mainly addresses short-term survival. So instead, our concept doesn't threaten the interests of domestic incumbent producer and sidesteps the problems being experienced between upstream and downstream industry interests by being export-orientated. It's established independently of the South African electricity grid and system, and it uses existing iron and steel export logistics. What are the enabling conditions? Establish the certified commodity. Then the EU government is already doing this. Deliberately accelerate demand for low emission steel. That's happening. And then this is the crucial enabling condition. The European Union has very strict rules for things like state aid, subsidies, etc., etc. It also commits to international level playing field, in theory at least, in its policies, and to open markets so that it keeps its own steelmakers competitive. So we're going to rely on the EU actually making good on those policies. It's going to be very complicated with a carbon border adjustment, CBAMs, and trade deals. There's been a recent trade deal between the USA and EU in steel. So this is an area where South African diplomacy and negotiations will need to focus so that by the time green steel is going, and that's going to be in about 3 to 4 years, where it actually becomes a number of plants are going to come online in Europe, that we're not left out in the cold. So that's going to really be where we have to focus our efforts. Collaboration will be necessary with Europe and other markets. The United States seems to be back in the game, prepared to play ball with South Africa in steel trade, etc. And if we manage to have successful diplomacy and negotiations with these lead markets, then the bankable market created through those efforts would enable a purely commercial investment in a 1 megaton green iron plant in South Africa around 2027 to 2030. And most importantly, this is for South Africa, it's for global sector decarbonization through least cost value chain arrangement, but also there are a number of other countries. There's Brazil, there are other African countries with iron ore reserves, Morocco, Algeria. And this example could be a prototype for the integration of existing and emerging steel sectors in other developing countries into equitable, just, global, sustainable economic development, so that in 20 years, to supply most of the steel to build, for example, African infrastructure, we don't replicate a world system where Africa makes 17 megatons of steel per annum and the world makes 1,800, leaving Africa completely out of global development. Thank you.
Thank you very much, Bryce and Hilton, for that really interesting presentation, and just also appreciating the fact that it's quite late in the evening. We do really appreciate you joining us. It's been a very interesting session. We're about to wrap up now for the day. So we've had a whole set of insights, experiences, and sharing by private sector as well on some of the initiatives that they're undertaking. We've had a range of conversations involving both the private sector and government, and really everyone who needs to be in the room to make South Africa's just transition possible. So we really do appreciate your contributions as well, and highlighting an area that was also pointed out as one of great potential for South Africa. So with that, I am going to close the session. I think we've had a lot of really interesting and fruitful kind of comments and insights that we can take with us into the evening. We will continue the Just Transition theme tomorrow. So we have a range of presentations, panel discussions, as well as opportunities to interact with some of the work that's taking place in South Africa. I'd like to wish you all.
May I make a social intervention?
I'm sorry, Hilton, can you just repeat that?
I'd just like to say, Bryce and I can't be there, but if he were and we were in the room, I would make sure to tell you that it's his birthday today. So we can wish him, even though he's like all of the pandemic victims is stuck in his flat.
I agree.
So it's his birthday today, so I just want to wish him a very happy birthday.
Thanks, Hilton.
Look, we'd like to wish you all a happy birthday, Bryce. It looks like as a birthday gift, we have one question in the chat that you might like to consider. So it's a question around the break-even cost to make this model viable.
So I did answer in the chat there, but it's from this analysis, we got around, it's around $2, a little more than $2 a kilo. Most of the literature that looks at these projections to 2030, they're all using very similar assumptions around the electrolyzer, which is one of the main components of the cost, as well as the solar costs, the cost for renewable electricity. So a lot of literature looks at is estimating between $2 and $2.50 per $2.50 in around the year 2030 per kilo. It depends a lot on a lot of variables, but it's roughly in that ballpark. Yeah.
Thank you very much, Bryce. I don't see any more questions either in the audience or online. I think we're happy to release you now, and really thank you so much for sharing of your time and your expertise so generously. Have a lovely evening.
Thank you.
Thanks, everyone. Thanks for having me.